Hello and welcome to part 2 of our Oregon series, Welcome to Oregon, of the Basic Tax course. We're going to begin part 2 of Welcome to Oregon with a review of the part 1 homework answer key. And of course the homework assignment was to look up tax on Oregonians for various amounts of Oregon income. And I already showed you how to look up the tax on the first question involving Mr. J. So let's pick up with question number 2. Mr. and Mrs. H are married filing jointly. Their Oregon taxable income is $27,075. So you would go into the Oregon Full Year Resident Booklet, look up the table for J and the amount of income, $27,075. If you do it correctly, you should get $2,007 of tax. For question number 3, Jane's filing status is head of household. For head of household, you also use the J column, and her taxable income is $43,006. That gives you Oregon tax of $3,447. Question number 4. John is single. His Oregon taxable income is $2,050, and that makes his Oregon tax $103. The next part of the homework assignment is to use the tax rate charts, and I already showed you at the end of last session how to figure the tax for question number 5. So we'll begin with question number 6. Jeff is single. His Oregon taxable income is $134,980, and to figure his tax, you begin with $134,980 and subtract out the threshold amount of $125,000. The $125,000 breaking point is the point at which Jeff will move into the 10.8% tax bracket. So any income he has above $125,000 is taxed at 10.8%. In this case, the amount of income he has being taxed at 10.8% is $9,980. $9,980 times 10.8% is $1,077.84. Next, we add to that the amount of tax that Jeff owes on the first $125,000 of Oregon taxable income. That amount is $11,036. We add $1,077.84 to $11,036, and we get $12,113.84. That, of course, rounds up to $12,114, which is the correct answer. Next, we have Sally, who is head of household. Her Oregon taxable income is $118,236, and we will use the joint tax rate chart. Now, the tax rate chart picks up where the tables leave off, and according to the tables, the amount of tax owed on the first $50,000 of income is $4,072, and the amount of income that Sally has over $50,000 is $68,236. That will be taxed at a rate of 9%, and 9% tax on $68,000 is $61.4124, and that leaves Sally owing $10,213.24 of tax, which of course rounds down to $10,213. Finally, we have question number 8. Mr. and Mrs. T are married filing jointly. Their Oregon taxable income is $57,355. The first $50,000 of income has a tax owing on it again of $4,072. So we're only interested in the amount that exceeds $50,000 for the year. So $57,355. Subtract out $50,000 leaves us $73,055. We multiply that by 9%, and we get $661.95. We add that to $4,072, and we have $47,33.95, which rounds up to $47.34 as being the correct answer. So that concludes the review of the homework assignment for Part 1 of Welcome to Oregon. At this point, please push pause on video playback. Take the Welcome to Oregon Part 1 quiz. And when you are ready, resume playback for the lecture portion of Part 2 of Welcome to Oregon. And in Part 2 of Welcome to Oregon, we're going to take a look at Oregon additions, Oregon subtractions, and Oregon deductions. And as I was sitting with my students in the classroom this morning, just getting ready to start talking, one of the things I said about Oregon is that Oregon has additions, subtractions, and credits out the wazoo. And if you are studying for the Oregon exam, learning enough about those varieties of additions, subtractions, and credits to pass the exam is probably foremost on your mind. So today's course is probably going to be
the most significant element of what we have to teach you for preparing for the exam. However, Oregon weighs very heavily on ethics. So on Thursday when we get over to part year and non-residents, we'll be teaching that in the morning, and then in the afternoon we'll be getting onto ethics. You cannot underestimate the importance of ethics. That's the easiest percentage on the test and the least amount of work to learn. Okay, we are at the point where we're going to get into the real meat of today, which is additions, subtractions, adjustments, and credits for Oregon. I'm starting our session, or this part of our session, on Oregon additions, subtractions, and credits by taking a look at the front of the Oregon Form 40. You'll notice up at the top of the form it says amended return, and that is the box you check if you were filing this form as an amended form. Down here in the lower section, you'll see there's some additional check boxes, and you need to check the one that applies, obviously age 65 or older or blind. And here's an interesting one. Did you file an extension? What it means is you filed a federal extension, and obviously if you filed an Oregon extension, you could still check the box. But if you don't check this box and then you file the return during the extension timeline, and you did file a federal extension, then the Oregon is, of course, going to assume no federal extension was filed and charge up to a 25% penalty. So it's a rather important little box to check. And then there are additional boxes here. Have you filed Form 8886? Have you filed Oregon Form 24? If there is a kicker refund, I want to donate mine to the state school fund. There is a very important box here, box 7E. If there is a kicker refund, I want to donate mine to the state school fund. Now, does anyone remember the controversy in the news, 2-3 years ago, where TurboTax was automatically checking that box? And the last time the state of Oregon had a kicker, a bunch of people who'd filed using TurboTax had inadvertently filed with that box checked, and they weren't getting their kickers, and they were rather upset about it. And to my understanding, Oregon said sorry. So, of course, the software should be defaulting to no on that, but you may have a client that does want to donate their kicker if one is issued, and that is where you make that indication. Now, moving on the form, we start with line 8, and the instructions for line 8 say whatever your adjusted gross income was on the federal return, that is the starting point for this form. That differs from Oregon Form 40S, where it actually gives you line entries for the types of income that you had. So Oregon Form 40S does not look at the federal return. It just says, what is your income, and enter it. But the long form Oregon 40 is saying, start with whatever your federal AGI is, and we're going to take it from there. And that brings me to the point that I like to make about Oregon, is that because Oregon starts with the federal AGI, Oregon is essentially saying, we're going to do things the way the federal does, except when we don't do them the way the federal does. Or another way of putting it is, Oregon is exactly like the federal, except when it's not. And so everything from this point forward on the Oregon form is about how Oregon is different. So we're the same as the federal, except we might tax some things that the federal didn't include in income. Or we might not tax a few things that you did include in federal income. And, you know, you do file as federal Schedule A, maybe to claim deductions, or maybe you claim the standard deduction on the federal, but Oregon has a Schedule A rule or a standard deduction rule as well, and we're going to apply that in the deductions section. So when we're done with Oregon deductions, and we're done with Oregon subtractions and Oregon additions, we finally get to the point where we have our Oregon taxable income. And we use that Oregon taxable income to then go to the Oregon tax tables or the tax rate schedules that I showed you earlier today to figure the Oregon tax. Once you've got the Oregon tax, now you move on to Oregon credits. And like the federal, Oregon divides credits into two categories: non-refundable credits and certain kinds of credits that are refundable, such as the Earned Income Credit, the Working Family Credit, and the Mobile Home Park Closure Credit. Those are refundable credits. So we're going to take each of these sections of the Oregon form in order, and that means, of course, we're going to start with additions. We'll move on to subtractions. We'll then talk about deductions, and then, of course, finish up with credits.
And the first password for Welcome to Oregon Part 2 is not associated with a test answer key. You will use it only for the password test, and the password is Archer, A-R-C-H-E-R.
Okay, so here we are back in our manual on page 16, additions, subtractions, adjustments, and credits. Oregon tax law closely follows federal tax law. However, there are important differences. Some income items not taxed at the federal level are taxed by Oregon, and some income items taxed at the federal level are not taxed by Oregon. Some federal adjustments, deductions, and credits are not allowed by Oregon. And Oregon has many adjustments and credits that are specifically applied to Oregon situations and are not allowed on the federal return. Oregon tax forms are designed to start with the results of your federal tax return. Changes that are then entered onto the Oregon return to account for these differences. And the differences between federal and Oregon law are usually accounted for in the form of additions and subtractions. You cannot report additions or subtractions on Form 40S. You must use long Form 40, or if you are a Part Year resident, Form 40P or 40N if you are a non-resident. Other additions. If you are reporting one or more other additions, identify the additions using the applicable numeric code. If you have only one other addition, Form 40 is filled out as follows. Enter the applicable numeric code on line 10X and enter the amount of the addition on lines 10Y and 10. Example. Jackie has federal adjusted gross income of $50,000 and is reporting a $500 addition for the Oregon Cultural Trust. She will enter code 104 on line 10X and $500 on line 10Y. And then she'll carry the total over to line 10. Do not enter a code or amount on lines 10X or 10Y if you are reporting more than one other addition. If you are claiming more than one other addition, check box 10Z and complete and attach Oregon Schedule ASC to your return. Enter the total from Schedule OR ASC on Form 40, line 10. Other subtractions. If you are claiming one or more other subtractions, identify the subtraction using the applicable numeric code. If you have only one other subtraction, complete Form 40 as follows. Enter the applicable numeric code on line 18X and enter the amount of the subtraction on lines 18Y and 18. And here's an example of this one. Jackie is claiming a federal tax liability subtraction of $3,000 and a subtraction for tuition and fees in the amount of $4,000. She will enter 308 on lines 18X and $4,000 on lines 18Y and 18. So just looking here at the Oregon Form 40, starting with the adjusted gross income, we enter additions for other additions on line 10. And you'll notice that the additions section is pretty small. It offers space for only one designated addition that is given its own line, and that is line 9, interest and dividends on state and local government bonds outside of Oregon. That is the only designated line for additions. Any other form of addition will always go on the other additions line. For subtractions, there's space for more designated types of subtractions. So we have, for example, line 13, the 2010 federal tax liability. Line 14, Social Security included in Federal Form 1040. Line 15, Oregon income tax refund included in federal income. Line 16, interest from U.S. governments such as Series EE and HH and I bonds. And then we get line 17, federal pension income. And finally, all other types of subtractions. So the point at which you need to file Schedule OR ASC is when you have more than one other subtraction on line 18 or more than one other addition on line 10. Here we have our example for Jackie. Her federal tax subtraction is $3,000, and she is claiming the Oregon tuition and fees subtraction. So that is a type of subtraction that it goes on the other subtraction line. She enters it with the appropriate code and then includes it in the total on line 19. So starting at the top, her income was $50,000. We increased it to $50,500 because of the addition, and then we've reduced it down to $43,500 through subtractions. Do not enter a code on or amount on line 18X or 18Y if you are claiming more than one other subtraction. If you are claiming more than one other subtraction, check box 18Z and attach Schedule OR-ASC to your return. Enter the total from Oregon ASC on Form 40, line 18. That one is a tongue twister to say. Other credits. If you are claiming more than one other credit, identify the credits using the applicable numeric code. If you have only one other credit, complete Form 40 as follows. This time you enter the appropriate numeric code on line 39X and the amount of the credit on line 39Y and 39. Here is an example. Jackie's Oregon tax from the Oregon tax tables is $3,526. Jackie will claim a $177 exemption credit. She will also claim a credit of $150 for the cost of long-term care insurance premiums that she paid. She will enter code 716 on line 39X. She will enter 150 on lines 39Y and 39. Do not enter a code or amount on 39X or 39Y if you are claiming more than one other credit. In that case, you have to attach the schedule again. But let's take a look at the credits that are given their own lines, because if you have a credit, you can have more than one credit as long as they're all falling on their appropriate lines. So we have the exemption credit on line 33, the retirement income credit 34, 35 is the child independent care credit, 36 is the credit for the elderly or disabled, and 37 is the political contribution credit. Finally, line 39, we have the credit for income taxes paid to another state. And then finally, if you are claiming credits that do not fall on any of those specific lines, then you use line 39 and you identify the credit with a code. And when you have more than one other credit that falls on line 39, that's when you need the schedule. Here is the schedule. It's a relatively new animal. Oregon introduced Schedule OR-ASC only about 3 years ago. Up until that point in time, you had to attach statements showing what your other additions, subtractions, and credits might be, and it did cause quite a bit of confusion, Oregon trying to understand, what code for how much. So that's why they introduced the schedule. Oregon requires taxpayers to file this schedule if more than one other addition, subtraction, or credit is used that requires a code. At the part year level, there is a separate form, which is the Oregon ASC PYNR, and it actually provides additional space for Oregon adjustments as well, but we'll talk about that in our class on part year residents. And today we're going to focus only on the codes and rules for codes that apply to full year residents. And again, in our next class, we'll see that some of those codes and applications of the credits, additions, and subtractions will vary for part year and non-residents. Now, Oregon's Form 40S, 40, 40P, and 40N allow specific line item entries for certain additions, subtractions, and credits. However, the majority of Oregon additions, subtractions, and credits, the vast majority, are not given specific lines. And that is the purpose of this form, is to address those. Now, here is a summary, and it's really not, Oregon doesn't put this in the instructions as a summary, but I use it as a summary because it in effect really shows you how many possibilities there are. You'll see right up here at the top, we start with federal adjustments to income. These apply only to Form 40N and 40P filers, and these are specific adjustment items that would go on the part year or non-resident return and the codes that are associated with them. We then move on to additions, Forms 40, 40N, and 40P only, and this is how you would apply these particular addition items. And what's relevant about the addition items is how many of them there are. So remember, the Oregon Form 40 allows space for only one designated item that is an addition, and that is state interest on bonds issued by other states. That's the only item that has its own line. Every other form of addition, you essentially have to know it in your head that it exists, because the form won't tell you that it exists. And you need to manually be able to go in and tell your software that there is an addition and what it is for. So we have the Oregon College Savings Plan, a non-qualified withdrawal. That can be an addition. Basis adjustments for things like assets that had different depletion or depreciation at the federal level than at Oregon, or different gains and losses at the federal level than at Oregon. Business credit unused. Business deduction and add back for Oregon credits. claim of right, discharge of indebtedness, disposition of inherited Oregon farmland or forest land, the domestic production activities deduction, federal election on interest and dividends of a minor child. Now, there are too many credits here, or additions here, for me to go into all of them today. It's physically, we just spend the entire day doing nothing but additions. So in our class today, we're going to talk about the ones that are the most significant, or the ones that will teach you how to apply the others, because there's essentially formulas that you use to figure out what your addition is going to be, and it's important that you understand how the formulas work so that anytime you get an addition, you can decide how am I going to calculate that addition. So moving on, we then get to the point on this list where we have some subtractions that apply only to Oregon Form 40, other subtraction codes that apply only to Forms 40N and 40P, and then more subtractions that also apply to all three variations of Forms 40, 40N, and 40P. And you can see how many subtractions there are. We then move into deductions and modifications. These particular codes apply only to Forms 40N and 40P. And then we move on into credits. And you can see how many credits and credit codes there are. All right, I'm going to do my best to teach you what the majority of those most important ones are. Oregon additions first. Oregon additions increase your Oregon taxable income. You may need to enter an addition to your income on your Oregon return if either of the following situations apply. You claimed a deduction or excluded income on your federal return that is taxable by Oregon, or you claimed a credit for an expense on your Oregon return and then also deducted that same expense on your federal return. Oregon law does not allow you to claim a double benefit for deductions that you make. So right there I've said there's two reasons why you have an Oregon addition. The first one is that Oregon taxes something that the federal did not. The second reason is that Oregon allows a credit for an item that is also deducted on the federal return. And now you're getting a credit and a deduction, and obviously that don't seem right either. So two purposes for additions. On March 8, 2011, the Oregon legislature reconnected Oregon to the federal definition of taxable income. Oregon is now tied to most provisions of federal law for tax year 2010. Oregon will automatically adopt any future federal law changes to the definition of taxable income. But of course, there are exceptions to the federal tie-in, and a number of these are budgetary for Oregon. Oregon is simply saying we will not allow it because we don't want to afford to allow it. And with our current budget crisis, there's some very significant ones here that Oregon does not allow. The first one is deductions allowed under Internal Revenue Code Section 139A, which has to do with federal subsidies for prescription drug plans. We don't commonly run across that in the course of our tax work. But the second, actually the third one in line we do. The second one in line is Internal Revenue Code Section 108, which has to do with discharge of indebtedness from the acquisition of an applicable debt instrument. Not going to see much of that either, but then the next one we do. Internal Revenue Code Section 179, the temporary federal increase of Section 179 expense deduction. What this rule is saying is that Oregon is looking back in time to where the Section 179 deduction used to be limited, and the fact that now the limit is $500,000, Oregon is saying we're not going to allow $500,000 of Section 179 deduction on the Oregon return for businesses that might qualify for that. We're going to hold it back to lower numbers that were available in the past. Also, Internal Revenue Section Code 168, which has to do with bonus depreciation. Oregon is saying, nah, we don't allow bonus. And Section 199, which has to do with the domestic production activities deduction. If you claim that deduction on the federal return, Oregon says, no way, you're going to have an Oregon addition. For tax year 2011, the legislature has reinstated a full rolling reconnect to federal tax law, including depreciation and expensing provisions. Oregon will remain disconnected from the exclusions under Internal Revenue Code Section 139A and 199. So what that's saying is that for 2009 and 2010, Oregon does not recognize bonus, and it also does not recognize the higher limit for Section 179, but beginning in 2011, it will. So the flip-flopping back and forth for us as tax practitioners, even staying on top of it and remembering it, is a virtual impossibility. I know we're all going to be making mistakes in this regard because our computer software in 2010 if it's accurate, will apply different depreciation methods to Oregon than to the federal if you made a note to make it do that. Sometimes it might automatically do it. Sometimes you might have to make some manual provisions. But let's just say you did get it right in 2010, and then the client moves to a new tax service, and you look only at the federal depreciation schedule when you're entering in depreciation for a new client. If you look only at the federal depreciation schedule and assume that Oregon was the same, you've already lost a bunch of money for them, because presumably the Oregon depreciation is different for 2010, which means in 2011, if you don't account for that difference, then you will be under deducting deductions for them on Oregon and making them pay too much tax to Oregon in later years. And then remembering again in 2010 that the rules that applied in for 2011, that the rules in 11 are different than the rules for 10 and 9, which in turn are different than the rules of 8 earlier. It's a mess, if you ask me. It would have just been easier for Oregon to say, we're different forever. Okay. Now income under these two sections, 139 and 199, 199 being the domestic production activities deduction. Income under these sections is exempt from tax on the federal return. If you have any of these types of income, you will have an addition on your Oregon return. If you are allowed to exclude certain income on your federal return, Oregon may require you to add the excluded income back on your Oregon return. The following items are not taxable on the federal return, but may be taxable on the Oregon return. And the first one we're going to start with is the one that is actually given a line number, line 9. Interest and dividends on state and local government bonds outside of Oregon. By law, the federal government may not tax bond interest or dividends of any U.S. state. In turn, the states may not tax U.S. government interest. Here are some important facts to know about state bond interest. State and municipal bond interest is generally referred to as tax-exempt interest and is sometimes reported in Box 8 of Form 1099 INT. Well, it certainly is supposed to be reported in Box 8 of 1099 INT, but if you're dealing with bonds, which are reported through mutual funds that invest in state bonds, then you're going to get a 1099 DIV, and at this point 1099 DIV does not display tax-exempt income real well, so you have to get the tax-exempt income by flipping through the tax documents or the year-end statements. But the 1099 INT has a specific box, and it's a relatively new box. That is, if you go back in time only 2 or 3 years ago, there was no Box 8 on the 1099 INT, and that way, or therefore, the only way that you would know that there was municipal bond interest or state bond interest was to actually flip through the back pages of the investment brokerage statement. So if you invested in state or municipal bond fund, you should receive Form 1099 DIV reporting your income from investments in the fund. A state or municipal bond fund is a fund that invests in bonds issued by U.S. states, territories, and municipalities. If you hold shares in a tax-exempt bond fund, the fund should issue a year-end tax statement showing how much of the fund's income is allocable to each state. The percentage of the bond fund that is not based on Oregon bonds is in addition to income on your Oregon return. Next item. If you excluded interest or dividend income from a U.S. state or local government on your federal return, you will have an addition to income on your Oregon return unless one of the following exceptions applies. The interest or dividend income is from Oregon or any other municipality outside of Oregon, or the interest or dividend income is from U.S. territories or possessions such as Guam, Puerto Rico, the U.S. Virgin Islands, and American Samoa. So here is an example. And I need to point out here that this concept of interest and how it's taxed on Oregon confuses preparers, and it's a frequently missed topic on preparer and consultant exams. And I just want to remind you that at the federal level, the federal government is not allowed to tax state bond interest. So if you have state bond interest, that is what could create an addition on Oregon. The flip of this is that the states cannot tax U.S. bond interest. And so at the federal level, you'll have U.S. bond interest that is taxed, but you'll have a subtraction on Oregon. And somehow the difference of where you have other state interest, which is an addition on Oregon, and U.S. interest, which is a subtraction on Oregon, preparers get confused. So I'm going to try and explain it well to you, and if you're still fuzzy on it after I'm done teaching you, then you need to really bone up on it. until it absolutely makes sense to you, because if it doesn't make sense to you, you will bomb these questions. Okay, here's my example. David's federal AGI is $60,000 and includes the following investment income for the year. $4,000 of interest in Box 1 of Form 1099 INT. What is Box 1? Ordinary interest, right? Taxed at both the federal and the state level. There is also $2,000 of tax-exempt interest reported in Box 8 of Form 1099 INT. And $500 of the tax-exempt interest is Puerto Rico interest, and $300 is Oregon interest. The remainder is interest from other U.S. states. How much of that, therefore, how much of this $2,000 is going to be an Oregon addition? $2,000 minus $500 minus $300 is $1,200. That's the Oregon addition due to interest from other states. And another $2,000 of dividend income, of which $500 was excluded from federal income because it was from state-issued bonds, none of which were issued by Oregon. So how much of that $500 will be an Oregon addition? All of it. So figure Oregon's addition of $1,700 as follows. There is an addition for tax-exempt interest not attributable to Oregon. $500 plus $300 of tax-exempt interest is not included in federal income and is also not taxed by Oregon. But the remaining tax-exempt interest of $1,200 will be an Oregon addition. The addition for tax-exempt dividend income attributable to Oregon. $500 of dividend income was not included on the federal income because it was from investments in state bond funds. Since none of the bonds are Oregon bonds, $500 will be an addition to David's income. David will enter $1,200 of interest plus $500 of dividend income on line 9. So now we move on to line 10 of Form 40, all other additions including accumulation distribution from a trust code 100. If you received a distribution from a trust's accumulated income from prior years, you will have an Oregon addition. If the trust paid Oregon tax on its income from the prior years, you can claim a credit for taxes paid in the prior years. Federal estate tax, also code 100, and you will notice that some of these codes are the same. If you paid federal estate tax on income not taxed by Oregon and claimed a deduction for this tax on your federal return, you may have an Oregon addition. Here's the important one. We're going to spend a bit of time on this today. Federal depreciation disconnect, code 101. Bonus depreciation for purchases made or assets placed in service on or after January 1, 2009 and before January 1, 2011 is not allowed for Oregon. Use the Oregon Depreciation Schedule Form 150101025 to determine your addition for Oregon purposes. Example 1. George placed in service a 7-year asset with a cost of $100,000. His federal and Oregon depreciation is calculated as follows. On the federal return, he is claiming 50% bonus depreciation and then depreciating the asset using half-year convention and 150% declining balance. On Oregon, he is depreciating the asset using the half-year convention and 150% declining balance. So here's how the depreciation is going to differ year to year. In 2009, the federal depreciation is going to be $55,355 because you take $100,000 in bonus 50%, that gives you $50,000, and then you have the remaining 15%, the remaining 50% being depreciated at half-year convention and 150% declining balance. So that gives another $5,355 at the federal level. Oregon is saying, wait, no bonus. You're just going to do the depreciation using 150% declining balance over the 7-year life. And in the first year after applying the half-year convention, that gives us $10,710 of depreciation. So the difference between these two numbers is $44,645, and that's an addition on the Oregon return for 2009. Now, in 2010, things are different because in 2010, the remaining basis available for depreciation on the federal return is much smaller. And the second-year depreciation available on the federal return will only be $9,565. But on Oregon, wait, we're going to get the biggest depreciation that's ever allowed under declining balance, which is always in the second year. And so Oregon is going to give $19,000 of depreciation where the federal is only giving $9,000. And that means that Oregon is actually going to have a subtraction for that depreciation in year 2. And we keep going forward in time, and you'll see each and every year after the first year we have Oregon subtractions that have to be accounted for. Oregon Depreciation Schedule 150-101-025 should be used each year to compute differences between Oregon and federal depreciation. Do not file this form with your tax return. Keep it with your tax records. You are required to fill out a new schedule every year that Oregon depreciation differs from federal depreciation. Do not use this form to show a difference in depreciation for an asset where you elected not to claim bonus depreciation, because your federal and state depreciation is the same in this instance, although of course the Section 179 limit may cause you to need it if you had enough being depreciated that you hit the Section 179 limit for Oregon. But here's an illustration. On 4/1 of 09, Clayton purchased a new production line for his business at a cost of $100,000. The asset has a recovery period of 7 years, and Clayton did not elect out of federal bonus depreciation. For his 2009 federal return, Clayton elected to claim 50% bonus depreciation and then used 7-year 200% declining balance under the half-year convention. Calculate his first-year depreciation as follows. Cost basis of $100,000 multiplied by 50% gives us bonus depreciation of $50,000. 200% declining balance and a half-year convention to the balance gives us another $7,143 of depreciation for the federal return. So at the federal level, the total depreciation claimed in 2009 is $57,143. Oregon, things are different. We're now going to take 200% declining balance and a half-year convention over 7 years. Oregon's first-year depreciation is $14,286. So how is this asset going to look? Well, for 2009, we have an Oregon addition of $42,857. And then for 2010, we're actually going to have a subtraction of $12,000. But it's a little more complicated than that, because when we get to 2010, Clayton is going to put more assets in service and kind of complicate the equation a little. Complete Clayton's 2009 Oregon depreciation schedule as shown below. The Oregon depreciation deduction was less than the federal deduction, so Clayton reported $42,857 as an addition on his Oregon return in 2009. Then in 2010 and all future years, his Oregon depreciation is going to be greater than the federal for that production line. So here's his Oregon depreciation schedule for 2009. The purpose of the schedule is ultimately to determine whether you have an addition or whether you have a subtraction, and the subtraction is entered on line 3. So ultimately, if the federal column is smaller than the Oregon column, you enter a subtraction on line 3. But if the federal column is larger than the Oregon column, you enter an addition on line 2. Let's continue with the illustration going on to 2010. Clayton made the following investments in equipment and improvements for his business. On 5/1 of 10, he made leasehold improvements costing $50,000. And on 11/1 of 2010, he purchased a computer system costing $10,000. How do things look on his federal return for 2010? Well, for 2010, on his federal return, Clayton will depreciate these assets as follows. Leasehold improvements, 50% bonus and 150% declining balance on the remaining cost. That gives us a cost basis of $50,000 multiplied by 50% for $25,000 of bonus depreciation. We're then going to apply 150% declining balance and a half-year convention to the remaining $25,000, and that gives us another $1,250 of depreciation. On the computer system, because it was placed in service late in the year, it actually qualifies for 100% bonus depreciation on the federal return, and that is the amount of deduction that's claimed. Oregon is different. Oregon does not recognize Section 168 treatment of leasehold improvements. Under Oregon depreciation rules, the leasehold improvements have to be depreciated as 39-year property under the mid-month convention. For 2010, Oregon does not allow bonus depreciation. The computer system must be depreciated as 5-year maker's property, 200% declining balance. 2010 depreciation for the production line is higher for Oregon than for federal. However, Federal depreciation for the leasehold improvements in the computer system is lower for Oregon than on the federal. Total 2010 Oregon depreciation is less than federal depreciation, so he has another Oregon addition in 2010. And let's look at the 2010 schedule. We'll see the production line that the Oregon depreciation in 2010 is higher than the federal depreciation. But then when it comes to the leasehold improvements, Oregon depreciation is actually much lower, only $802 of depreciation allowed by Oregon on the leasehold improvements. Compare that to $26,250 allowed at the federal level. And then on the computer system, $2,000 is the most we'll get out of Oregon. 200% declining balance gives us $2,000 compared to 10 on the federal. You total these two columns, you have 48 federal, you have 27 Oregon for a difference of $21,203. And that will carry over to Oregon Form 40 as an addition, and you will enter addition code 101 on the line. Now there is a working group exercise in your manual. Yes, it's page 53. And what I'd like you to do now is spend about 10 minutes mulling through Sandy Cheeks Part 1. Sandy Cheeks purchased and put into service a computer network costing $20,000. Sandy will take bonus depreciation and depreciate the remaining cost of the network using 5-year Maker's half-year 200% declining balance. Calculate the addition that Sandy has to report on her 2010 Oregon return, and then calculate the subtraction Sandy will claim on her 2011 Oregon return. Now this is 5-year declining balance, so I can tell you that the first year percentage for double declining balance is 20%, and the second year depreciation percentage is 32%. Go ahead and take 10 minutes to work your way through this problem. This type of exercise is just done to help you reinforce what it was I was talking about. What we're seeing in the first year of depreciation on the network is that federal is allowing this big deduction for bonus, and Oregon is not allowing that. And so Oregon depreciation in the first year is coming out at only $4,000, where the federal is allowing $12,000. The difference between those two numbers is 8, and that is the Oregon addition for 2010. Moving into 2011, we're going to figure $3,200 of depreciation on the federal, twice that amount for Oregon, giving us an Oregon subtraction in 2011. So I remember the next topic was the domestic production activities deduction, right? Okay, so that is actually page 30 of your manual. Let's pick up there. So the domestic production activities deduction, Oregon law does not follow federal law with regards to the domestic activities production deduction. If you claimed the deduction on your federal return, you will have an addition on your Oregon return. Identify the addition on line 10X by entering code 102. Enter the addition amount on Form 40, line 10Y. And in this illustration here, we have a federal Form 1040 that has been filed. And you can see that the federal Form 1040 has claimed the domestic activities production deduction on line 35. As soon as you have a number on line 35 of your federal return, that's an automatic addition on Oregon. It shouldn't take any more thought than that. Oddly enough, computer software may or may not pick up on that elementary piece of information. And certainly our own computer software that we've been using, Drake, in prior years was not picking up on this and automatically triggering an addition, which meant if our preparer missed the addition as a manual entry, of course Oregon figured it out and sent an embarrassing letter to the client. So I'm giving our bad, sorry state of excuse as an illustration for you to watch out for what we have sometimes failed to do ourselves. Because this is such an easy item for computer software to grab, you would think it would automatically do it and not even think about it. But as a tax preparer, when you do a tax return, you should look at the finished federal form and then go, okay, let's move over to Oregon. And does Oregon look like I think it should? In your mind, you should already know what additions Oregon should have on it before even looking at the finished form to see if that software grabbed those additions for you. Federal deduction for long-term care insurance premiums. Oregon allows a credit for the cost of long-term care insurance premiums. If you claim this credit on your Oregon return, Oregon requires you to add the cost of the long-term care insurance premiums back to your income if you claim a deduction for the cost of these premiums on Schedule A. This is to prevent you from claiming both the deduction and the credit on your Oregon return. If you claimed an itemized deduction for the cost of long-term care insurance premiums and you claimed an Oregon credit for the same expense deducted on Schedule A, figure your Oregon addition using the following formula. This formula is different than other formulas that are there for additions because it isn't as what you might expect, that if you claimed a credit for long-term care insurance premiums, that whatever amount of qualifying expense you use for the credit will be the addition on the federal. It's not that way at all. They have you do a formula that gives you a lower number. So it's to the benefit of the client, really, that this formula works the way it does. You take the total cost of the long-term care insurance premiums that were included in federal itemized deductions, and you divide that by the total medical itemized deductions figured on Schedule A, line 1. You then multiply that by the federal medical deduction that was allowed on Schedule A, line 4 to get the Oregon addition. So let's look at an example of how this works. And I have to say this is one of the most common manual calculations I do in a tax season for the Oregon Form 40. I have to do this several times every tax season because I have lots of clients who are claiming this particular credit and then also itemizing and claiming deductions for medical expenses. Sierra, age 43, paid premiums of $1,350 during the year. But because of her age, her federal return Schedule A deduction for the cost of premiums is limited to $620. Sierra has other medical expenses of $3,120. Her total medical expenses on Schedule A are $3,740. Sierra has federal adjusted gross income of $38,000, so she must reduce her medical expenses by the 7.5% limit, which is $2,850. Her allowed medical deduction is $890 after applying the limit. So we see here her total medical expenses on line 1 are $3,740. Her AGI says $2,850 of that $3,740 is not deductible, leaving us with $890. Sierra will compute her Oregon addition as follows. Take the amount that is included on line 1 for long-term care insurance premiums, and that's $620. Divide that by the total expenses included on line 1, and then multiply that out by the amount of expense that's allowed on Schedule A to get the Oregon addition. So her Oregon credit is allowed in full, but the addition is only going to be $148, not the amount that she actually used to calculate the credit. Income tax paid to another state. If you claimed a tax credit on your Oregon return for taxes paid to another state and also claimed a deduction for the taxes paid to that state, you may have an Oregon addition. Now this can be an object of confusion for people. When you get to the Oregon Schedule A, you are allowed to claim a deduction on Schedule A for taxes paid to Oregon. You're also allowed to claim a deduction on Schedule A for taxes paid to other states. And a question that sometimes people ask is, well, does Oregon allow a deduction for taxes paid to other states? I know it doesn't allow it for taxes paid to Oregon, but will it allow a Schedule A deduction for taxes I paid, say, to California? And the answer is yes. So Oregon is saying, if you claimed a tax credit on your Oregon return for taxes paid to another state, and then you also deducted those taxes on Schedule A, then you can't do both, and you're going to have an Oregon addition. Self-employed health insurance deduction code 104. If you claimed a self-employed health insurance deduction on your federal return and claimed the Oregon credit for long-term care and premiums, you may have an addition to income on your Oregon return. Film Production Development Contributions Code 104. If you claimed an Oregon Production Fund credit and claimed a deduction on Schedule A for your contribution to the Oregon Film and Video Office, you will have an Oregon addition. Oregon Cultural Trust Contributions. If you made a charitable contribution to an Oregon organization that is a member of the Oregon Cultural Trust and then made a matching contribution to the Oregon Cultural Trust, you may claim a credit on your Oregon return. If you claim the credit on your Oregon return, you will have an Oregon addition. If you also claimed a deduction for the matching donation on your federal return. Here's an example. Tim contributed $400 to the Oregon Zoo. He made a matching $400 contribution to the Oregon Cultural Trust. He then deducted all $800 on Schedule A and claimed an Oregon credit of $400. So he will be allowed an addition of $400. This is actually a pretty good deal. His deduction is still allowed on the federal return, even though the Oregon credit essentially means he had no expense at all. And all Oregon is saying is at the Oregon level, we're not going to allow that double benefit. Now, how many of you are familiar with the Oregon Cultural Trust? Are you able to explain it to your clients or how to take advantage of it? I got one nod and some head shakes. So let's just stop a minute, and I'm just going to go to the internet, and let's just type Oregon Cultural Trust and see what comes up, just for the fun of it. And you can see I've been on this site a few times before. You go into it. And the starting point is that what you should observe is that there are over 1,200 arts, heritage, and humanities organizations across Oregon that participate in the trust. And what that means is that the likelihood that your client made a contribution to an Oregon charity that is a part of the trust, pretty close to 100%. So pretty much any Oregon-based charity that has anything to do with Oregon assets, you know, whether it's our zoo or museums, is probably going to be a part of this trust. And if it is, all that your client has to do is make the contribution to their charity the way they normally would, and then turn around and make a matching contribution to this trust. And there's actually some searches you can do in here to figure out who is a member. I believe it's divided by county. And then you'd have to look to see who in your city is a member. I'm just going to randomly pick Baker City. So if you happen to live in Baker County, there are 8 charities in that county or city area that are members of the Oregon Cultural Trust. So it would behoove you to be familiar with who the charities are in your area that your clients could be donating to, but the reality is that your client could live in Portland and make a contribution to any county in Oregon or any charity within any county and have something that is a member of the Oregon Cultural Trust. And here's one: Friends of the Oregon Trail Regional Museum, Sumter Valley Railroad Restoration, Inc., and the Trail Tenders. So again, your client, all they need to do is make the contribution to the charity listed here the way they normally do. Then they turn around and making a matching contribution directly to the trust, and they get 100% of that matching contribution back on Oregon, up to $500 for a single filer, twice that for married, and it's $2,500, I believe, for corporations. So it's a pretty good free deal, but all it takes is the client to be aware of it, and they have to, of course, take action on it. And in all the years I've been doing tax returns since the Oregon Cultural Trust credit came out, I've had like one client do it. It really surprises me. So on the Oregon Cultural Trust, you take advantage of that opportunity to make your contribution to the trust. You claim a deduction on both the Oregon return and the federal return. You claim a credit on Oregon as well. And since you are double deducting on Oregon, that's why you will have an Oregon addition. Okay, gambling losses claimed as an itemized deduction. This is going to be a favorite topic on the Oregon exam. They're sure to ask this one. If you excluded Oregon lottery winnings from your income and you claimed a deduction for gambling losses as an itemized deduction on Schedule A, you must adjust your Oregon income so gambling losses are no greater than gambling winnings taxed by Oregon. And here's an example. So Lewis had the following wins: Oregon lottery of $1,000, Oregon Powerball of $500, and Washington lottery winning tickets of $300. So his total wins are $1,800 for the year. He has $1,500 of losses, which he is deducting on Schedule A, and he is also claiming an Oregon subtraction for this Powerball ticket. There's a rule in Oregon that says you can claim a subtraction on your Oregon return for winning tickets on Oregon lottery that are winning tickets of $600 or less. So he's allowed to claim a subtraction on Oregon for this $500 Powerball ticket. But if he is also claiming an itemized deduction for his gambling losses, there's a possibility that he's going to end up with a double deduction on Oregon. And in this respect, in this illustration, The total winning tickets that get taxed by Oregon is only 1,300 of the 1,800. But he's itemizing deductions for 1,500, and so we've got a double deduction to the point of $200, and that's why we have a $200 addition for Oregon. Federal election on interest and dividends of a minor child. If you file Form 8814 to include income of your child on your return, some of this income is in addition to Oregon income. And I don't have an illustration in here, but we just covered this exact topic in our federal CPE series a week ago. And in that series, we took a look at Form 8814. And I'm just going to make a note of how 8814 works. Form 8814 is used to calculate tax on investment income of child reported on the parent's return. And if you recall, thinking back to how that form works, there's a couple things that happen on the form, more than a couple. But the first thing that comes to mind for me is that when we're filling out that federal Form 8814, we're going to claim a standard deduction for that child equal to $950. So $950 if the child's income is not taxed at all. We then have another $950 that is taxed as a rate of 10%, and we get a $95 tax then. And where does that tax go? Carries to page 2 of the 1040, right? We check a box on the back of page 2 of 1040, and we include, and actually that box is on line 44 of Form 1040, we include that $95 of the child's tax in the tax of the parent. But that $95 doesn't appear anywhere on the front page of the return, does it? And the $950 associated with it also does not appear anywhere on page 1 of the return. And since it's not on page 1, it's not an adjusted gross income. And if it's not an adjusted gross income on the federal return, do you think Oregon is just going to let it go? No. So the Oregon addition would never be more than $950, because that's the most that gets taxed at 10% and added to the parent's tax. It could be less than $950. You know, if you had a child with, let's just say $1,200 of investment income, and the parent elected to include that on the parent's return, the parent would exclude $950 from tax, and then it would include the difference between $950 and $1,200, which would be another $250, as income subject to 10% tax, and it would generate $25 of tax that would be added to the parent's return. But again, that $250 of income appears nowhere on the front page of the 1040, so again, you'd have an Oregon addition, in this case for only $250. So that's just something to bear in mind on that particular addition and how it works. Federal income tax refunds due to amended returns on prior years or audits. If you amended a prior year federal return, you must claim an Oregon addition for federal refunds that reduce your federal tax below the federal tax subtraction amount for the earlier year. So for 2009 and 2010, the federal tax subtraction is the same, and is also the same for all filing statuses. For 2008 and earlier years, the federal tax subtraction has been progressively less as you go back in time. And for all earlier years, 2008 and earlier, the married filing separate federal tax subtraction was half that of joint. And beginning in 2009, it pays to file separately on Oregon in that regard. Okay, so the way it works for this particular addition is, let's just suppose you filed a tax return for 2007, and on that tax year you claim a federal tax subtraction of $5,000 on your Oregon return. You then amend the federal return and you reduce your tax to, say, $4,000. Well, there's a spread there, or a difference, between the federal tax subtraction that you did claim and the new federal tax that you've actually had to pay. And that spread is what becomes the Oregon addition. But it only applies when you are in the zone that equals the federal subtraction for the earlier year or less. If your federal tax in 2007 was $10,000 and you reduced it on an amended return to only $7,000, you're still above this threshold. So you wouldn't have an addition because you didn't drop your tax lower than the amount you deducted on the Oregon return in the earlier year. So let's look at an example here. We have a character named SpongeBob who is single, and he filed his 2007 federal return showing a federal tax liability of $2,750. SpongeBob claimed a federal tax subtraction of $2,750 on his Oregon return for that year. Then in 2010, he amended his federal return to claim additional deductions. As a result of the amendment, he reduced his federal tax liability to $2,250 and received a refund of $500. Since SpongeBob filed his amended return and received a refund in 2010, he enters $500 as an addition to income on his 2010 Oregon return. His addition to income is calculated as follows. The federal tax subtraction allowed on the original Oregon return, and the difference that is now being shown as a liability on the amended federal return. That difference being the addition amount. Here's a second example. This case, Patrick, also a single filer. He filed his 2008 federal tax return showing a federal liability of $6,000. That's more than the maximum amount allowed in 2008, right? So what's the 2008 subtraction? Limited to $5,600. So in 2010, Patrick amends his 2008 federal return to claim an additional dependent. His federal tax liability on his amended return was reduced to $4,500. That's a $1,500 difference. And he received that $1,500 as a refund. Patrick must report an Oregon addition to income on his 2010 return that is $1,100, because $1,100 is the difference between the liability subtraction he originally claimed and the reduced liability. $1,100 would be his Oregon addition in that case. Individual development account. If you are an individual in a lower income household and an individual development account or IDA allows you to accumulate assets tax-free. If you hold an IDA, you can make deposits to your account tax-free. Your deposits are matched by private donations. Withdrawals from the fund are tax-free if they are for a qualifying purpose, including paying higher education expenses, purchasing a primary residence, or starting your business. If you withdraw money from your IDA for a non-qualifying purpose, you will have an addition on your Oregon return. I should point out that if you read Pub 17.5 on IDAs, it's been a while since I've looked at it, but it has a few pages devoted to IDAs and all their iterations. There are IDAs that are set up for the beneficiary, to which the beneficiary can contribute and from which the beneficiary can withdraw. And then if you are not a beneficiary of the account, you can make contributions to the accounts of beneficiaries and claim credits for those. So there's about 3 different ways IDAs impact tax filers, and it can be worthwhile to read that section on IDA accounts in Pub 17.5 because it describes them in a completely different way than I cover them in this course. In this course, I strictly look at the rules for when you have an addition and how to calculate it, and when you have a subtraction and when you have a credit. So withdrawals from the fund can be tax-free if they are used to pay for qualifying expenses, including higher education, purchasing a primary residence, or starting a business. And if you withdraw money from your own personal IDA for a non-qualifying purpose, you will have an addition on your Oregon return. Lump sum distributions. If you completed Federal Form 4972 to figure tax on your qualified lump sum distribution using the 20% capital gain rate or the 10-year tax option, your pension income from 4972 was not included in your federal AGI. If you paid tax on your pension income, use Form 4972, you will have an Oregon addition. Okay, now this particular addition item works exactly the same way as the addition for income of a dependent included on the federal return, that you have a separate form for that dependent that you use to calculate tax on a separate line that carries to page 2 of the federal 1040. Well, lump sum distributions work exactly the same way. The lump sum distribution is not included in federal adjusted gross income. The income is reported on a separate form. The tax is calculated separately and carried directly to page 2 of the 1040. And because the form works that way, that is why you have an Oregon addition. Oregon College Savings Network. If you withdrew funds from an Oregon 529 college savings plan for a non-qualifying purpose, you will have an addition on your Oregon return. Funds spent for the following are examples of qualifying distributions: tuition fees, books, supplies, and equipment, and room and board at an eligible educational institution anywhere in the United States and in foreign countries. Qualifying schools are listed on the U.S. Department of Education website at this URL. Oregon subtractions. So we finished with what I have to say about Oregon additions, and you can see I've touched on just some of them, that there is a whole long list of all of the others. And you should at least read Pub 17.5 and trigger your brain cell in case they decide randomly to choose one of the others I didn't cover today. But we're now moving on to Oregon subtractions, and we're going to spend a lot more time talking about subtractions than we did talking about additions. Subtractions, of course, reduce your Oregon taxable income. Certain amounts that are taxed on your federal return may not be taxed by Oregon. Amounts that are included in your federal income and not taxed by Oregon are claimed as subtractions on Form 40, page 1. We're going to begin with the very first line on the Oregon form for subtractions, and that line is line 13, which has to do with the federal tax liability. Oregon allows you to claim a subtraction for your federal tax liability. Generally, your federal liability is the tax on Form 40, line 55, or Form 1040A, line 35, or Form 1040 EZ, line 11. Of course, after subtracting out, you're making work pay credit. But please note that your federal tax liability is not always the number that appears on line 55 minus your making work pay credit. It can be increased or decreased by other line items, including line 58, which is an increase, and line 58 is where you report the additional tax or penalty on early distributions from IRAs and simple plans. It also can be reduced by credits, refundable credits, like the Making Work Pay credit, the American Opportunity credit, and the first-time home buyer credit. And it can also be increased by certain handwritten in line items for recapture taxes that appear on line 60, and in certain cases on taxes paid through Form 5405, but not all times that you pay tax through Form 5405. 5405, of course, being the form that you use to repay the first-time homebuyer credit. So depending on the reason why you're making a repayment, you may or you may not have an increase to Oregon tax based on the number that you enter on line 59 for box C. And of course, on the next page of our manual, I've circled or highlighted the items that will reduce your federal tax liability subtraction for Oregon. And they include the Making Work Pay credit, the American Opportunity credit, and the first-time homebuyer credits. Do not confuse your federal tax liability with your balance due. Your liability is the amount you owe in tax for the year, regardless of whether you have withholding. The method of calculating the subtraction is based upon an accrual method of accounting rather than a cash method of accounting. That is, you claim the subtraction based on federal taxes owed or payable for the year rather than on federal taxes that you actually paid during the year. Oregon allows you to claim taxes you paid on your federal return as a subtraction from Oregon income. The amount of the subtraction is the lesser of your federal tax liability, or $5,850. Your federal tax liability includes only income taxes. You are not allowed to a subtraction for other taxes you might be required to pay, such as self-employment tax, Social Security and Medicare tax on tips, or household employee taxes. For 2010, the federal tax subtraction is limited to $5,850 for all filing statuses. For all years prior to 2009, married filing separate was allowed half the normal subtraction. Every filing status is allowed the subtraction unless a taxpayer falls under the new income limits, which provide for a phase-out of the deduction. Married filing separate and single filers begin the subtraction phase-out at $125,000 of AGI. All other filing statuses begin their phase-out at $250,000 of AGI. If your income is higher than these amounts, refer to the federal tax subtraction tables and worksheets to calculate your allowable deduction. So here is that table. This is a new animal. Remember, we had an election or a ballot measure in 2010 in tax season to establish whether or not we were going to accept higher rates of income tax for high-income individuals, as well as take away their federal tax subtraction. And the answer is yes, we did pass that law. So for the first time ever, we have to worry about phase-outs where there never used to be a phase-out. And the phase-out works like this. If you are single or married filing separate and your income, your federal adjusted gross income is at least 0 but less than 125, then you're allowed a full subtraction. And as your income increases, the subtraction phases out until when your income is $145,000 or more, you are allowed 0 federal tax subtraction. It's actually a fairly rapid rate of phase out, only a $20,000 spread, and it's wiped out. For married filing a joint return, head of household or qualifying widow, you don't hit the phase out at all until federal adjusted gross income is $250,000. And in this respect, the phase out occurs between $250,000 and $290,000 or a $40,000 range. Items that affect the federal tax subtraction. There are several items that may affect your federal tax subtraction. I already pointed them out on the form, but we're going to discuss each of those in turn now. Use the federal tax subtraction worksheet to account for these items, beginning with the federal first-time homebuyer tax credit. Depending on which first-time homebuyer credit you claimed, your federal tax subtraction may not or may be affected. If you claimed the credit for a home purchase in 2008, this credit, which was a maximum of $7,500, is required to be repaid and therefore is considered a loan and consequently did not reduce the federal tax liability that you were able to deduct on your 2008 Oregon return. That means that you do not reduce your federal tax subtraction if you received this 2008 credit back in 2008. Also, you do not increase your federal tax subtraction by any repayments you make to the IRS for your 2008 homebuyer credit. So looking at that line on 59 where you check box C on the 1040, for 5405, if the amount you're entering on that line is a part of the repayment of the 2008 credit, that repayment will not increase your federal tax liability subtraction because you were already allowed to deduct your federal tax liability in 2008. That was not a reduction to the 2008 liability. But wait, what if you claimed the credit for a home purchase in 9 or 10? This credit, which was a maximum of $8,000, is not required to be repaid and therefore is considered a reduction to your federal tax liability. You must reduce your federal tax subtraction by the credit, but not below 0. So if in 2010 you claimed a first-time homebuyer credit for either 2010 or 2009, and whatever the amount of the credit is, you're going to subtract that off your federal tax liability and therefore reduce your federal tax liability subtraction on Oregon. So if you elect to amend your 2008 federal return to receive the 2009 credit early, and that is the only change to your federal return, do not amend your Oregon return. Instead, reduce your 2009 federal tax subtraction by the amount you received as a credit, but not below 0. If you repaid part or all of your 2009 credit in 2010, because you no longer met the use and ownership tests, you can increase your 2010 federal tax subtraction by the amount you repaid, but not above $5,850. So that's a very specific formula going on in your head. If it's the $500 per year amount for the 2008 repayment, I make no adjustment to my federal tax subtraction for Oregon. But if I'm making a repayment because I ceased to qualify for keeping the credit on my federal return, and therefore was forced to repay the credit on my federal return for a credit that is attributable to a 2009 or a 2010 home purchase, it is those repayments that can increase my federal tax liability subtraction for Oregon. The next item of discussion is the making work pay credit. This credit will reduce your federal tax liability and must be taken into account when figuring the federal tax subtraction. The American Opportunity Credit refundable portion. The refundable part of this tax credit reduces your federal tax liability. If the credit reduces your federal tax liability to less than $5,850, your federal tax subtraction will be reduced. Federal tax paid on a prior year. You can take a subtraction for federal tax paid for a prior year if you paid additional federal tax in 2010 on a prior year amended federal return. Enter the additional tax paid as an other subtraction on line 18 of your Oregon Form 40, and then enter subtraction code 309. Your combined federal tax subtraction entered on line 13 of Form 40 plus the subtraction for federal taxes paid for a prior year cannot be more than $5,850. Your allowed subtraction may be reduced if your income exceeds certain threshold amounts. Foreign tax subtraction. You can claim a subtraction for foreign taxes paid of up to $3,000. The combined amount of your federal tax subtraction, federal tax paid for a prior year, and the foreign tax subtraction cannot be more than $5,850. Your allowed subtraction may be reduced if your income exceeds certain threshold amounts. And that's kind of a lot to absorb, so I created an illustration for you to show how all of this works. Mr. and Mrs. Squidward's federal tax on line 46 of their federal Form 1040 is $4,000. They are claiming tax credits for the American Opportunity Credit and the Making Work Pay Credit. They also owe self-employment tax, an early distribution tax, and began making repayments on their 2008 first-time homebuyer credit. What is their federal tax subtraction for Oregon? Okay, we're already dizzy. Well, let's just break it down into its component parts. The tax shown on line 55 of the federal Form 1040 is showing right here $3,000. So they have $4,000 of federal tax on line 46, and we're claiming an American Opportunity Credit in the amount of $1,000. So we get down to line 55, $3,000 is our starting point. We then look at what increases will Oregon allow, and Oregon will allow this additional tax for the early distribution from the IRA or pension of $600. So $3,000 plus $600, but of course no adjustment is allowed for this 2008 homebuyer repayment. We then move down to what are going to be the reductions to the federal tax subtraction. We're going to reduce the federal tax subtraction by the $800 Making Work Pay Credit, and we're also going to reduce it by the refundable portion of the American Opportunity Credit. So by the time we're finished with all these calculations, we end up with an Oregon subtraction for the federal tax liability for the year of $2,400. Now, Oregon, of course, has a worksheet that you can use, and the worksheet ultimately takes you through all of those steps. One of the things we did notice internally on this worksheet, just actually preparing for this class yesterday, was that the worksheet says enter any recapture taxes shown on line 60, but it doesn't ever talk about line 59C. And so we were wondering, where's the confusion? And actually, when I go into the Pub 17.5 or into the Oregon booklet, it says include on line 60 recapture taxes, for example, the first-time homebuyer credit. But of course, the first-time homebuyer credit does not appear on line 60, it appears on line 59. So there seems to be a lack of clarity in the people who actually wrote the instructions. And in earlier years, 2009, of course, there was no designated checkbox for the repayment of the first-time homebuyer credit, and it did appear on the equivalent of line 60. But beginning in 2010, it has its own line. Okay, Form 40, line 14, Social Security income and Tier 1 railroad. Federal law prohibits states from taxing Social Security benefits. If you included taxable Social Security benefits or Tier 1 railroad retirement benefits on your federal return, you should claim a subtraction on your Oregon return. And here is an illustration. Clint East included $12,750 of taxable Social Security income in his federal adjusted gross income. He will enter a subtraction for this amount on the Oregon Form 40, line 14. So I got out of my way to explain something that should be fairly obvious to all of you, but the Oregon subtraction for Social Security benefits is only equal to the amount that was included in federal adjusted gross income. You can't claim the full amount of benefits received because those are not in federal adjusted gross income. So Oregon, of course, starts with the total adjusted gross income from Federal Form 40, line 37. That pulls over to line 8. And we are then looking at what was included in federal adjusted gross income that Oregon does not tax, and this is the number Oregon does not tax. Form 40, line 15, Oregon refund included in federal income. If you claimed Oregon income tax as an itemized deduction in a prior year and you received a tax benefit from the deduction, you must include any subsequent refund as income on your federal return to the extent you originally benefited by deducting it. Since Oregon does not allow you to claim a deduction for Oregon income taxes you paid, you do not need to include your Oregon refund in your Oregon income taxed by Oregon. Claim a subtraction for the portion of your Oregon refund that was taxed on your Oregon return. So I know I'm off topic now, but I wanted to get it while it's still on my mind because it's rather important. Oregon says that when you have a change on an amended federal return to the federal tax liability, Oregon does not want you to go back and amend the prior year Oregon return and change the liability. So if your 2009 federal return shows a liability of $5,000 and you claim $5,000 on your Oregon return as a federal tax subtraction in 2009, and then you go back and you amend the federal return and change that liability down to $4,000, Oregon does not want you to go back in time, amend the Oregon return, and reduce that liability to $4,000, and then pay the difference back to Oregon as a balance due. They say, forget it. Keep the liability on the back of your Oregon return the same as what showed up on the original federal return, and take that $1,000 refund and put it on as an addition in the year that you received that refund. So that's a very odd concept. It's kind of backwards to what you would think is the case, especially if the reason for amending the federal return is a reason you are also amending Oregon. So you're going back in time to 2009 and you're amending Oregon for the same reasons you're amending the federal. And your instinct is, okay, my original federal subtraction was $5,000, now I need to reduce it to $4,000. You're not supposed to. You leave it at $5,000 and continue amending Oregon for all of the other reasons you need to amend it. And then when that federal refund of $1,000 comes, it becomes an addition in the year of the amendment. So you can see it's kind of an important explanation, and it was just in my head. I couldn't remember it a little earlier. Okay, the next topic of the day is interest and dividends on U.S. bonds and notes. This is a line item, and remember I said that preparers frequently get confused about when we have the addition and when we have the subtraction. We have an Oregon addition when we have interest or dividends on bonds of other states. We have a subtraction when on the federal return we reported income from U.S. bonds. So very important to get those differences settled in your head. And of course, Form 40, line 16 is a subtraction. Federal law prohibits states from taxing U.S. government interest and dividends. If you reported interest from U.S. Series EE bonds, Series HH bonds, or Series I bonds, Treasury bills, or notes on your federal return, you can claim a subtraction on your Oregon return. Note, though, that interest you received on a federal refund is not U.S. bond interest and is taxed on both the federal and Oregon returns. Do not claim an Oregon subtraction for interest on your federal tax refund. Many mutual funds invest in U.S. government obligations. A mutual fund investing in U.S. government obligations will issue a document reporting the percentage of income from the fund that is U.S. government income. There is a difference in how Oregon treats these types of bond funds and how other states treat them. So if you are preparing tax returns for a client that has income or residency, say, in California, the California calculations for this subtraction type item are different than Oregon's. And in California, a certain percentage of the fund has to be invested in federal bonds before California allows a subtraction. And on Oregon, any percentage is going to create a subtraction. So it's just a caution there that we're not talking about California law, but in the ordinary course of being a preparer, we're going to be asked to prepare out-of-state returns. And you should just be aware that some things that seem obvious for Oregon are not necessarily going to follow through to the other state you might end up preparing. So here is an example for Oregon, of course. Selma received $1,500 of dividend income from Lucky Investors Fund. The fund states that 20% of its income comes from U.S. government obligations. Selma will enter $1,500 of dividend income on Form 1040, line 9. She will claim a subtraction of $300 on her Oregon return. So this $300 isn't showing up on any kind of tax document, not on a 1099 DIV, not on a 1099 INT. You need to actually look at the bond, read the description of the bond fund and what it invests in, and establish if any portion of that is investments in federal bonds. And to the extent that there is a percentage, you have to manually figure that addition and put it on the return. Form 40, line 17, federal pension income. If you are a federal retiree, you can subtract pension income reported on your federal return from Oregon income. The subtraction is based on the number of months you worked for the federal government prior to October 1, 1991. And there's little doubt in my mind you will be asked to work this formula on the consultant exam, so you need to know it and how it works. It's not that complicated a formula, and it is a formula I do manually multiple times every single tax season. If all of your federal pension benefits are based on years of service prior to October 1, 1991, you can subtract all of your federal pension income from your Oregon return. If you retired on or after October 1, 1991, you must prorate your federal pension subtraction using the following formula. You look at the months of service before 10/1/91 and divide that by the total months of service, and then multiply that number by the federal pension amount that you included in federal income. That will give you the Oregon subtraction. Here is an illustration. Maverick retired from the U.S. Navy on 1/12/06 after 25 years of service. His federal pension income for the year is $40,000, and his federal AGI is $70,000. Calculate his federal pension income subtraction as follows. Look at the total number of months of service. 25 years times 12 months is 300 months of service. How many months of service were after 10/1/1991? It's 171 months. And how many months of service were before 10/1/1991? 129. We're going to take the number of months of service before 10/1/91 and divide that into the total months of service. And when we do that, we get 43%. The Oregon federal pension subtraction will therefore be 43% of $40,000 or $17,200. And we enter that on line 17. We have to enter the percentage amount on line 17A and the amount of the subtraction on line 17. Now, I have observed that computer software offers opportunities to do these calculations automatically, and so far I've yet to see a computer software effort that even approached accuracy. And even if you get it to do it right in 1 year, it loses it the next. So this is really a calculation that needs to be done manually. And once you've made it manually, it's best to put some kind of note into the computer system that will carry forward to the next year, so that when you go in and work on that return again the next year, the note is there to remind you that this was the amount of the subtraction. I always talk about Drake because that's the software program that I use. And I have to be careful where I put that note because not all note screens pull forward every year. So I do make a point of putting it in a place where I know the next year when I go into that return, that message will pop up and say, oh, the federal pension subtraction percentage is 32% or 85% or 92%, whatever amount it is I calculated. That way I remember to do it year to year. One of the more common errors I observe when I prepare tax returns for first-time clients, and I'm looking at who did the return last year and what that person did a year ago, this is a very frequently missed subtraction, and it's huge. So I had a lady that came into my office 2 years ago, and oh my gosh, she'd been going to a CPA for 15 years. And early on, he was catching this subtraction, and in her case, it was 100%. And then he sold the firm to new CPAs. And for 1 or 2 years, the new CPAs caught this subtraction, and all of a sudden, they dropped it. And every year, for 10 years, they made her pay tax to Oregon on income that's not taxable by Oregon. Well, of course, Oregon will only allow you to go back 3 years to amend. So she'd paid more than $1,000 a year every year for 10 years, as a result of the CPAs dropping that subtraction. Now, my client had a very aggressive son who went down to that CPA firm, and that CPA firm coughed up the dough. So they did not want to deal with the angry son when he found out that his poor mama had had to pay too much on account of their negligence. And rather than even begin to argue about it or go to court or anything, they just coughed it up. But that's a pretty expensive cough up. So don't miss this one. The other thing, that was not the only mistake I saw on the back of your returns. The other mistake I saw was that she was eligible for the simplified general method for calculating the taxable portion of her federal pension, and they'd missed that too. So they were making her pay too much to the federal and too much to Oregon. So two separate things that you have to be concerned with. When you're dealing with military pensions, you typically do not have a simplified general method worksheet that you need to fill out. But when you're dealing with federal pensions for, say, retired postal workers, for example, then you typically do have annuities where there is a cost basis and you do need to do the simplified method worksheet. Okay, now Oregon does provide a worksheet for figuring the federal pension subtraction. If you understand the formula, you do not need the worksheet. But just to show you how it works, I did copy it into your manual and I even filled it out for you. The starting point is, what is the federal pension that was included in federal adjusted gross income? It then says, what is the months of service? Fill in the service start date prior to October 1, 1991. And then line B, months of service from 1/12 of 81. That's the date, obviously entering into the military. And then to the date of retirement. Now you notice I have an exact 25-year spread here, and that is because most people who work for the federal government do work an exact number of years. They have a retirement date that's spot on the higher date. So that's the part that generally makes it easy, although you still have a date that will not coincide with October 1. You don't have people that hire or retire on October 1 very often. It's technically possible, I suppose. Most people are going to hire and retire on a day other than that, so you're still doing all these finger counts. At least if you're me, you're counting on your fingers to figure it all out. We were at a point where we were going to start to discuss all of the other federal subtractions that fit onto line 18. And we're going to begin with American Indian code 300. So if you noticed, all of our additions started with ones. And all of our subtractions apparently are going to start with threes. Okay. American Indian. Enrolled members of a federally recognized tribe may be able to subtract income earned while living and working in Indian country in Oregon. To qualify, the tribal member must have derived income from sources within Indian country in Oregon and lived in Indian country in Oregon at the time the income is earned. Indian country means any federally recognized Indian reservation or other land that has been set aside for the residence of tribal Indians under federal protection. You must file a completed Form 150-101-049, Exempt Income Schedule for enrolled members of a federally recognized Indian tribe, with your Oregon return. You must include all of the following on the schedule: the street address of the place you worked, the street address of the place you lived, the tribe you are enrolled with, and your membership number. You must include your street address on the schedule so that the state of Oregon can verify that you live in Indian country. However, you may use your post office box address on your tax return. Construction worker and logger commuting expenses, code 303. If you worked as a logger or a construction worker, you may be able to deduct the cost of certain commuting expenses as a subtraction on your Oregon return. To claim the subtraction, you must have worked at one or more construction projects or logging operation sites that were more than 50 miles one way from home. No subtraction is allowed for expenses that have already been deducted as an employee business expense on the federal return. So let's look at what a qualifying construction project is and what a qualifying logging operation is. Construction projects include the construction, alteration, repair, improvement, moving, or demolition of a structure. Qualifying construction workers must be members of a recognized trade, craft, or union. Construction workers can claim their qualified commuting expenses only for the first year of continuous employment at any one construction site. This is a very different concept than what we have on the federal return. On the federal return, remember, commute expenses are specifically not deductible, that you have to be assigned to a temporary work location that is outside of your metropolitan area. And construction workers typically don't have a central work location, but when they travel outside of the metro area, they can get a deduction. And therein lies the reason why this just doesn't come up very often, because most of the time when we do have a construction worker who is traveling outside their metropolitan area, they're going to be able to deduct stuff on Schedule A, claim their deductions on Schedule A, and therefore that Schedule A deduction is being claimed and they can't duplicate it with this particular subtraction. So this subtraction is specifically reserved for a construction worker or a logger who has commute expenses and is not already deducting them on Schedule A under the rules allowed there. So if you don't deduct on Schedule A and you are a construction worker and you travel more than 50 miles one way from home to a work site that lasts 1 year or less, then you get to deduct these costs. The second category is logging operations. Logging operations include the commercial harvesting of forest products. Qualifying loggers must be fallers or buckers who maintain their own equipment and are paid on a per unit cut basis. There is no time limit on how long a logger may work at the same job site and still claim expenses. Qualifying expenses. You can claim only the actual cost of gas, oil, repairs, and maintenance. You cannot use the standard mileage allowance, and you cannot claim a deduction for depreciation on your vehicle. Difference in depreciation for Oregon. Oregon may allow you more depreciation than on your federal return. If Oregon allows you more depreciation, claim the difference as a subtraction on your Oregon return. Basis of business assets transferred into Oregon and depreciation and amortization. Well, this is going to tie hand in hand now with the earlier working group exercise we had where we figured difference in depreciation for Oregon and federal for tax years 2010 and 2011. Well, the flip side of that is when it comes time to sell an asset, if it's had different depreciation on the federal and different depreciation on Oregon, it's going to have different basis for Oregon than the federal, and there will be a difference in gain. So basis of business assets transferred into Oregon and depreciation and amortization, that is another reason why you'll have a difference in basis. Your Oregon depreciation deduction is usually the same as your federal. However, if you placed your property into business use in another state, your Oregon depreciable basis will be different than your federal basis. Here is an example. Joan owns a rental property in California. She placed the property in service in 2001 when she was a California resident. In 2010, Joan moved to Oregon. Oregon's depreciable basis is different than her federal or California bases, and that's because she's never depreciated the items on Oregon. If Joan's Oregon depreciation deduction is more than her federal deduction, she will have an Oregon subtraction. If Joan's Oregon depreciation deduction is less than her federal deduction, she will have an addition. Sale of assets. Your Oregon basis in assets may be different than your federal basis if you sell an asset with a different basis. You will have an Oregon addition code 101 if your Oregon depreciation is more than your federal depreciation, and you will have an Oregon subtraction if your Oregon depreciation is less than your federal depreciation. So remember earlier we looked at that working group exercise on page 53 and it had two parts, part 1 and part 2. Well, we did part 1 and now we're going to take a look at part 2. Same sandy cheeks, but this time we're going to figure out what happens if Sandy Cheeks turns around and sells this asset for $8,000. So remember that Sandy had a difference in depreciation between the federal and Oregon in 2010. And then we asked you to figure out what that difference in depreciation would be for 2011 in part 1. Well, in part 2, now she's going to dispose of it. But remember that in the year of sale on a depreciable asset, you're going to apply the half-year convention, right? So if she applies the half-year convention in the year of sale, it means you're going to have to refigure depreciation for the year of sale and then sell the asset. And of course, the asset would appear as an item sold on Form 4797, and it's going to produce a gain or a loss for the federal return. There will be a difference in that calculation for Oregon, and whatever that difference is should be a subtraction, right? So I'm going to pull up the answer key for part 1. Because that's going to be your starting point for part 2. So this is the part 1 answer key. And what I'd like you to do is you'll see here we had the 2011 depreciation calculation. If we dispose of the assets or the asset in 2011, we're going to have to divide the depreciation calculation for the federal and the depreciation calculation for Oregon in 2. And then we're going to add 2010 depreciation to 2011 depreciation, get the sales price, and figure what our net gain is or loss is on the sale for federal and what the subtraction will be for Oregon. So just take about 5 minutes to figure your way through that, and then I'll put up the final answer key. So what we're seeing is that this is a three-stage problem. The first stage is we have to figure what the second year of depreciation is on both federal and Oregon. And then the second stage is to add current year depreciation to the prior depreciation to get total depreciation claimed on the federal and total depreciation claimed on Oregon to get our adjusted basis. And our adjusted basis, of course, is all depreciation claims subtracted from the original cost. And when we do that, we end up with, of course, a much lower basis on the federal than we have for Oregon. And so ultimately on the federal, we ended up with a basis of $6,400. And on Oregon, we ended up with a basis of $12,800 at the point where we're selling. And for the federal, that means we sell for $8,000 on an asset that has a cost of $6,400 or an adjusted basis of $6,400, and it gives us a gain on the federal return of $1,600. So if we can visualize what's going to happen on the federal return, we're going to have a Form 4797. We're going to fill out page 2, part 3 of Form 4797. Remember that, class? And in that part, we show the cost, we show the prior depreciation, we show the sales price, and we show the recapture amount of depreciation. And it's going to be producing ordinary income when we do that of $1,600. It's going to carry to line 14 of the 1040. But Oregon is not going to tax that number because Oregon does not produce a gain. Because of prior year additions, Oregon's got actually a loss on the disposition. So the Oregon loss on the sale is actually the $8,000. Oregon's basis is $20,000 minus $7,200. So we had $6,000 of depreciation allowed in the first year. We're allowed $3,200 in the second year. And when we do that, we end up with these lower amounts. So anyway, we end up with a basis of $12,800. We sell for only $8,000. That gives us a loss of $48,000. And then the difference in depreciation between the two is $6,400. So we're ultimately going to have a subtraction to enter on the Oregon return, and the amount of that subtraction is $6,400. We're going to enter that on line 18 and enter code 304. So we have this answer key for you guys to take home, and it's also in the LMS for the online students. Okay, so let's go back to our manual, and where were we? 44 is where we left off. Something just tells me lots of tax preparers are going to be missing those calculations. It's a lot of work to keep track of that. If you're using computer software and the tax return stays in that same software year after year after year, the software should remember it. But again, if you are taking on a new client and that client's coming into you, it's going to be really, really important to be looking at their prior year depreciation schedules for not just the federal, but also for Oregon. All right, the next subtraction item we're going to look at is the tuition and fees deduction. And earlier in the year, like in January of 2011, Oregon published a list of the most common mistakes that it encounters on Oregon filed returns, and the tuition and fees deduction was close to the top of that list. And I have to tell you that working in our tax office, this is a frequent problem that we see our own preparers making, that when we are doing error checking of tax returns prepared by our preparers, this is an error we are looking for. Routinely, we're seeing preparers mix this up. So not only are paying attention to see if this is an error you yourself are making, but if you are supervising the work of other preparers, you can be working on the assumption that they will be making this error on a regular basis. Oregon does not have an education credit. If you claimed the American Opportunity or Lifetime Learning credits on your federal return, you can subtract up to $4,000 of qualifying expenses on your Oregon return. The subtraction prevents Oregon from taxing income used to pay qualifying educational expenses when the taxpayer opts to claim a federal education credit instead of the tuition and fees deduction. To qualify for the subtraction, you must claim an education credit on your federal return. If you claimed both the tuition and fees deduction and an education credit on your federal return, your Oregon subtraction is reduced by the amount of the tuition and fees deduction that you claimed. The Oregon subtraction is the lesser of qualifying tuition and fee expenses used to calculate the education credit on your federal return, or $4,000. And here's an example. Jacob paid $2,000 of qualifying education expenses for himself and another $2,000 of qualifying education expenses for his son. He claimed the following education expenses on his federal return. $2,000 as a tuition and fees deduction, and $2,000 as an American Opportunity credit. Jacob will claim an Oregon education subtraction in the amount of $2,000. Now, one of the things that is confusing to people is when do I get to claim this subtraction on Oregon and when do I not get to claim it? You do not get to claim it if you are already claiming a tuition and fees subtraction that is $4,000. the tuition and fees deduction on the Oregon return is making up for the fact that you didn't claim the deduction on the federal return because you claimed an education credit instead. So you don't claim the tuition and fees deduction on Oregon except where an education credit was claimed. And what people do is they claim the tuition and fees deduction on the federal return, and then they go, oh, I need to claim the tuition and fees deduction on Oregon. Well, how does Oregon think and work? Oregon starts with federal adjusted gross income. So if you claim the tuition and fees deduction on your federal return, it's already deducted on Oregon. You don't do it again, right? The only time you get it on Oregon is when you didn't claim it on the federal because you claimed an education credit instead. So let's not rely on computer software. I'll tell you about what went on with Drake's software this season. One of the complaints I had for Drake, remember I told you earlier in class today that Drake routinely every year had these errors over and over and over again. One of the big errors it had was on 4797. It was generating it when it didn't need to. When a person sold a home in which they'd claimed depreciation, their home that they lived in, it was generating 4797 in a situation where it's not required, and it just annoyed me. Because every year I had to kind of, anyway, it doesn't matter what I needed to do, it was a problem. But another problem that Drake was always having was with the tuition and fees deduction, and that it was not generating it automatically. And so our staff, or anyone in Oregon using the software, had to know to manually make that subtraction entry. And preparers were entering subtractions when none was allowed because it was already on the federal. Preparers were forgetting to put it in when it was allowed. It was just a constant thing that we were on the lookout for. Well, after I complained about it to Drake last year, the tax season 2011 started, and it was in there for the first time ever. It was calculating automatically, but guess what? We had a situation for Oregon that until the legislature met and ruled and decided on whether or not it was going to allow the tuition and fees deduction for Oregon, we didn't know if we had a tuition and fees deduction for Oregon. And in fact, the way it was currently set as the tax season started for 2011, that when we were preparing 2010 returns, if a tuition and fees deduction was claimed on the federal return, we were going to have an addition on Oregon. Because Oregon, as we started the year, was not allowing for that deduction, right? And so the Oregon Department of Revenue sent out warnings, multiple warnings at the start of tax season, that if you have a client that qualifies for the tuition and fees deduction or the educator expense for teachers, that you should hold off on filing and not file at all until the legislature had decided what to do. Well, the legislature did not make a decision until March. So we in our tax office were really clear on this issue, and we had dozens of clients that were sitting in pending bins where we had filed their federal returns, but we were not filing Oregon until we heard. And finally, when Oregon did decide to allow the deduction, we had a situation going on with our Drake software. At the start of the season, it was allowing a subtraction where it shouldn't. Then later on, it was creating an addition where it shouldn't. And finally, it got it where it was right as we approached the end of tax season. But it was just a topsy-turvy world. And in one part of the season, we'd have to enter an addition to overcount the subtraction that didn't belong there. And then later on, the addition was there, but it didn't need to be because they corrected the software to get rid of the problem. And then later on, we needed to enter the subtraction, and they finally caught up. But it was just a topsy-turvy season for computer software to try and keep up with Oregon, and Drake actually responded faster than a lot of other software companies. So I like to complain about them, but on the other hand, I do know that they were better at it than I think TurboTax was. They took longer. So I heard TurboTax is still, as we approach the end of March, really behind the ball. So of course, this is an area that is frequently a problem for the Oregon Department of Revenue, and I have to think that this year it was just an absolutely enormous problem. The news that came out in the newspaper, the Oregonian, following all of this, was that there were huge numbers of people who had not delayed filing, who had gone ahead and filed, and there was some hope that the Oregon Department of Revenue was going to automatically calculate the differences and send them refund checks. And at first, news came out from some people at the Oregon Department of Revenue that they might do that. And then, of course, it was corrected that no, they're not going to do that. And so the only way people who did file could solve the problem was to actually file amended returns. So we really had a messy tax season for Oregon this year. And that's 2 years in a row where the Oregon government or an Oregon election ballot measure have fallen in the tax season where we've not known what to do. Okay, federal tax from a prior year. If you were amended or you were audited on a prior year federal return and had to pay additional federal tax, you can claim a deduction for that federal tax on your 2010 Oregon return. The amount you can deduct is the prior year federal tax paid added to this year's federal tax paid, but not exceeding $58.50. So again, like I described earlier today, if you amend a back year federal return and you owe with it, you do not go back to the back year Oregon return and increase your federal tax subtraction. Rather, any additional tax you pay in 2010 for a prior year amended federal is going to be a separate subtraction claimed on the Oregon return. But it is not an increase to the federal liability claimed on line 13. Rather, you look at whatever amount you entered on line 13 and add to that amount another amount for the amount of increase on line 18X and line 18. But you cannot go higher than $58.50 between the repayment and the actual liability for the current year. So here's an example. Jackie's federal tax liability for 2010 is $4,000. In 2010, Jackie amended her 2008 federal return. The original federal return showed federal tax of $2,000. The amended return increased the federal tax to $4,500, which is an increase of $2,500 over the original return. Jackie's 2010 federal tax liability is $4,000, and she also paid additional tax due to a prior year in the amount of $2,500. Since her total deductions for federal tax cannot exceed $58.50, she will enter $4,000 of federal tax liability on her Oregon Form 40, line 13. And then she will enter the difference between that number and the maximum of $58.50 on line 18. So when you take those two numbers, you get to that maximum, and you can't be higher. Foreign income tax, code 311. You can claim a subtraction on your Oregon return for taxes paid to a foreign country if you claimed a credit on your federal return for taxes paid to the foreign country, or even if you did not claim a credit for tax paid and also did not claim the taxes as an itemized deduction on your federal return. Remember, with the foreign tax credit, you have a choice on the federal return of claiming a credit or of claiming a deduction on Schedule A for taxes paid. You can't, of course, do both. And Oregon is saying, we don't care what you do, just don't do both to us either. So if you claim a federal credit, you can go ahead and claim an Oregon subtraction of up to $3,000. If you claimed an itemized deduction instead, then you would not claim an Oregon subtraction. Your combined subtractions for foreign taxes paid and the federal tax liability cannot exceed $58.50. Also, the foreign tax portion of your federal tax subtraction cannot be more than $3,000 or half that amount for married filing separately. Here is an example. Patty Single has a federal tax liability of $5,000. She also paid $3,000 of foreign tax. Her federal tax subtraction is going to be limited to $58.50, so she'll be able to claim $5,000 on the line 13 and $850 on line 18. Individual development account, code 314. You can claim a subtraction on your Oregon return for deposits you made to your IDA through the Neighborhood Partnership Fund. The subtraction is the amount of deposits made and interest received that you included in your federal taxable income. For more information about the Neighborhood Partnership Fund, go to this URL. Also read the instructions in publication 17.5. So you have the individual development account that is set up for you. Money is put into it. That money grows, and you are allowed to take that money out and use it for specified purposes. If the interest income generated by that account is taxable on the federal return and you use the money for a qualifying purpose, then you're going to be able to claim that subtraction on Oregon. Military active duty pay. Okay, here's another favorite for the consultant exam. You may be able to claim an Oregon subtraction for some or all of your military active duty pay. Now, my thinking on this one is the reason why it's a most frequently missed topic for Oregon is that we just don't have any military bases here in Oregon, do we? We have very few military, and unless you're like me who was married to the military at one time, this stuff can seem really foreign. But I was a Navy wife in my younger years, so this stuff always made sense to me from day one, and I always was spot on. But I've worked with so many people that are confused by it, and it's been a subject of high error rate on the Oregon exams. So we'll take a real close look at it here today. You can claim a subtraction on Oregon for some or all of your active duty military pay. And there are rules for when you are allowed to take a subtraction, and there are multiple different types of subtractions you can claim. Firstly, to claim a subtraction for military active duty pay, you must have included that pay as income on your federal return. For example, combat pay is not taxable. So if it's not taxable on the federal, you couldn't claim a subtraction for it on Oregon. Make sense? Also, you can subtract up to $6,000 of active duty pay that you earned inside Oregon. So you're stationed in Oregon, you worked in Oregon, you're a resident of Oregon, and you have active duty pay earned inside Oregon. You can claim a subtraction of up to $6,000 a year. If you're married and your spouse is in the military, you can each claim up to $6,000 a year. Beginning in 2008, a new rule was created, and it says that weekend drills of reservists and National Guard members is considered active duty provided you were required to be away from home for 3 or more consecutive weeks during the year. Prior to 2008, weekend drills were not considered to be active duty pay. So let's just talk about what happens with reservists. When a person joins the reserves, they're obligated to 1 weekend a month and 1 2-week period in a year, basically their camp. So they usually have their weekend drills, 1 weekend a month, plus once a year they have to go away for 2 full weeks. So your typical person in the military will not qualify, right, because they're only gone for 2 weeks. So you're looking for those specific situations where that individual was gone for more than the normal 2 and was actually gone for 3 or more weeks during the year. Now the 2-week camp is generally considered to be active duty, and the weekend drills are usually not considered to be active duty. So with any particular individual who was a reservist or a National Guard reservist during the year, you can anticipate that they'd have 2 weeks of pay that is a subtraction for Oregon, and the rest would not be a subtraction on Oregon. And the problem is figuring out what that subtraction is, because there's nowhere on the W-2 that they indicate it. Years and years ago, they used to put a code 14, actually a code W in box 14 that designated active duty pay. And I'm not sure exactly when the military stopped using that code, but they stopped. It's been a number of years ago now that they stopped. And there's nowhere on the W-2 anymore that the military tells you what the active duty pay is. They do tell you what combat pay is, but they don't tell you what active duty pay is. And we need to know active duty pay. So how do I get that information? Well, when I do have someone who is in the military, I will ask them to log on to their account. They have payroll accounts, internet-based payroll accounts where they can go in and actually print their pay stubs. And there in the payroll information, they are able to access the type of pay they received, because all military pay is always broken down on a pay stub as to what it is. There's a certain amount of pay that every military person gets which is tax-free, and that's usually their housing allowance. Okay. There are other types of tax-free military pay they could be getting, for example, combat pay. And then there's other types of pay that are fully taxable, and depending on what your job in the military is and what your rank is, you're going to be getting all different kinds of pay, some of which are taxable, some of which are not. And then above and beyond all of that, if you're dealing with a reservist, you're looking to see how much of their taxable pay was for active duty and how much of their taxable pay was for those weekend drills. And the only way to figure that out is to actually have that reserve member go in and look the information up. Now, if you do have a person who is a reservist or a National Guard member and they were away from home for 3 or more consecutive weeks, then you don't need to figure out how much was active duty. They're going to get it all treated as active duty. So, to repeat it, time spent at reserve camp is considered active duty. That's the 2-week stint. Your total active duty pay subtraction cannot be greater than your active duty pay income. If you entered into or you were discharged from the military during the year, you can subtract all of your active duty pay earned outside of Oregon during the year. You can subtract all active duty pay earned outside Oregon until such time as the President calls a halt to hostilities in the Persian Gulf area. If you were called to active duty from Title 32 to Title 10 since 2001 and you had an active duty service in Oregon, you can subtract all active duty pay you earned while you served under Title 10 in Oregon. So normally Oregon service in Oregon, active duty service in Oregon, is limited to $6,000 a year. But if you were called to active duty under Title 32 or Title 10, and that is essentially you were one of those reservists or National Guard members who was recruited by Bush to send off to Iraq, then any active duty pay earned inside Oregon is a subtraction, even if it exceeds that $6,000. Also, you can qualify for more than one active duty pay subtraction, but the total subtraction cannot exceed the total active duty pay included in federal income. So let's just suppose you are an Oregon resident. You've been doing your weekend drills and your 2-week camps inside Oregon. Very small number of people who that applies to. We do have a small base here in Portland, small Air Force base, and we also have some people stationed in Oregon who are, say, Navy recruiters or Army recruiters. So those types of people are going to be active duty in Oregon. There are a few of them out there. And they're going to be limited to $6,000 a year for the most part. But if they were called to active duty under Title 32 or Title 10, in addition to that $6,000, they can also subtract all active duty pay earned inside Oregon. But let's just say you've got some active duty pay earned inside Oregon, and then you also have active duty pay earned outside Oregon. That inside Oregon is limited to 6, and active duty pay outside Oregon is not limited at all. So you could have up to 6 in Oregon plus all active duty pay outside of Oregon. Crystal clear now, right? Okay. Mortgage interest credit. Federal law allows certain mortgage holders to claim a credit for amounts spent on home mortgage interest. The amount of the federal credit claimed is not allowed as an itemized deduction on your federal return. Since Oregon does not allow a credit for home mortgage interest paid, you can claim a subtraction for home mortgage interest you did not include on Schedule A because you claimed the home mortgage interest credit instead. Well, there's a pattern we're seeing here already under subtractions, and that pattern is if the federal would have allowed a deduction but didn't allow it because you claimed a federal credit, but Oregon does not have the same credit, Oregon says, we're going to give it to you anyway. So the tuition and fees deduction is an example that I've given you already. This second one is the home mortgage interest credit. So at the federal level, you reduced your itemized deductions because you claimed a credit, and because of that, Oregon is saying, oh, we're going to give you an extra subtraction equal to the amount you didn't deduct on federal because you claimed the credit. Here's an example. Mr. Krabs holds a mortgage interest credit certificate. His allowable federal credit is 20% of his qualifying mortgage interest expense. Mr. Krabs paid $10,000 of qualifying mortgage interest. He reports his mortgage interest on his federal Form 1040 as follows. On Form 1040, line 53, he claims a $2,000 mortgage interest credit. On Schedule A, he claims an $8,000 mortgage interest deduction. That is $2,000 less than he otherwise would have claimed on Schedule A had he not claimed the credit. So it stands to reason that Oregon is going to allow that $2,000 to be a subtraction on Oregon Form 40, and you enter it on line 18 and put the appropriate code, 320, next to it. And here we go with the Oregon lottery. This is for sure going to come up on the Oregon exam. I'm giving you so many guarantees, I'm just trying to figure out, they only have 50 questions they have to give you, right? And if 25 of those questions are ethics, it's not, they probably have about 12 questions that are ethics. So the number of topics that I know they're going to focus on, that's why there's so much that I don't talk about that I'm feeling pretty comfortable. They probably won't question you, but just to cover your bases, read page 17.5. But of course, this is one they're sure to get you on. Oregon does not tax Oregon lottery winnings of $600 or less on any single ticket. If you reported Oregon lottery winnings on your federal return, you can claim a subtraction on your Oregon return equal to the total of all winning tickets of $600 or less. Oregon lottery winnings include winnings from Powerball tickets purchased in Oregon. You may subtract all Oregon lottery winning tickets included in your federal income if your winning ticket was purchased before January 1, 1998. What's up with that? Well, it happens to be that before 1998, any amount of Oregon lottery winnings were a subtraction on Oregon. You could win the big one, $1 million, and you'd have a subtraction on Oregon for the whole win. And at some point, Oregon said, oh, yeah, we're going to stop it at $600, right? But that law is not retroactive, and there are some people who who purchased winning tickets prior to 1998, who instead of claiming all of the big win at one time, elected to receive payments over, 30 years, 20 years, something like that. And because they're receiving it over that period of time, it's possible that you could have a person in the year 2010 who is reporting on their tax return income received in 2010 for a winning ticket purchased before 1998. And if that's the case, that's 100% subtraction for that winning ticket regardless of the amount received in the year. And I know that was, at one point, a most frequently missed question on the Oregon exam. They gave an illustration with a person who had purchased a winning ticket before 1998, that person then had winnings that were being paid in a later year. How much of those winnings were a subtraction? And the answer is all of them. Okay, here is another kind of example. Jenny had the following winnings during the year: California Powerball, $600, Oregon Lottery, $500, Oregon Powerball, $300, Vegas Slots, $1,500, for total wins in the year of $2,900. Jenny can claim an Oregon subtraction for $800 because this is the amount of the Oregon Lottery wins on winning tickets of $600 or less. Of course, California Powerball is $600 or less, but it is not Oregon Powerball. Oregon 529 College Savings Network. Oregon allows a subtraction of up to $4,180 if married or RDP filing a joint return, and $2,090 for all other filing statuses, for contributions to the Oregon 529 Savings Network. This state-sponsored plan meets the federal qualifications for the special tax status as a Section 529 plan. Contributions of more than $4,180, or half that amount for other filing statuses, can be carried forward and subtracted over the next 4 years. Well, this is another one that computer software probably doesn't have a trigger in to remember. If you have a client that during 2009 contributed $10,000 to their child's college savings plan, the most they could deduct if they were married in 2009 was $4,180. But they put $10,000 in, which means in 2010 you can deduct another $4,180, even though they didn't actually make a contribution in 2010. How many knew that? Nobody. So the computer software is probably not even going to think along those lines. It's just something you need to know in your mind as a preparer. So if your computer software has any kind of an entry field where you can make a note to remind yourself in the subsequent year what that carry forward is, you should do so. Because, you know, tax rate of 9% times $4,000 is $360. Yeah. And if it were my money, I'd want it. Subtraction amount limits for earlier years. In 2009, the maximum subtraction was $4,170, half that for all others. In 2008, it was $4,000 and half that for all others. And prior to 2008, it was $2,000 and half that for all others. What is the Oregon College Savings Network? The Oregon College Savings Network is a Section 529 plan that is set up to allow you to either prepay or contribute to an account established for paying a student's qualified higher education expenses at an eligible educational institution. The program must meet certain requirements. Your state government or the eligible educational institution in which you are interested in attending can tell you whether or not they participate in a 529 plan. How much can you contribute? Contributions to a 529 plan on behalf of any beneficiary cannot be more than the amounts necessary to provide for the qualified higher education expenses of the beneficiary, but there are no income restrictions on the individual contributors. You can contribute to both a 529 plan and a Coverdell ESA in the same year for the same designated beneficiary. And of course, the difference between a 529 and an ESA is that if it's the Oregon College Savings Plan, you get a deduction on Oregon. And with the Coverdell ESA, you don't get a deduction anywhere. So if you have a child that will be attending school under a plan that is the Oregon College Savings Plan and you find that that's a fund that you want to invest in, there's the added incentive of a tax break for Oregon. There was a lot of stuff in the news in the last few years about one fund managed by Oppenheimer, yeah, that was the name that came to my mind too, that had been very badly managed. I don't think, the fund has dropped in value a lot, but it's also done some recovery, and the state of Oregon has been giving Oppenheimer some trouble over it. So I think some compensation is expected to be paid out to people who lost money there. But I think other than the Oppenheimer Fund, most of the Oregon College Savings Funds have actually been reasonably respectable, but given, of course, that there's been fluctuations in the market, too. So are the distributions from the fund taxable? The part of a distribution representing the amount paid or contributed to a 529 plan does not have to be included in income. This is a return of investment in the plan. And that's the federal rule. The beneficiary generally does not have to include in income any earnings distributed from a 520 plan established and maintained by a state or an agency or instrumentality of the state if the distribution is equal to or less than adjusted qualified higher education expenses for the year. Adjusted qualified higher education expenses include tuition, fees, books, and room and board. Form 1099-Q. You will receive a Form 1099-Q Qualified Tuition Program payment under Section 529 from each of the programs from which you received a QTSP distribution in 2010. To calculate if any of your withdrawal is taxable, follow these instructions. Now this year I looked at 2 tax returns for 2 new clients who both had distributions from qualified tuition savings plans in Oregon last year, and the money was spent on qualifying education, and their darn accountants put it in income. It was like, what? Essentially what they had was CPAs or tax preparers who got a 1099-Q and didn't know what to do with it, so they put it in income. So there's almost no situation where it will be 100% taxable, and in both these cases it was treated as 100% taxable. That's fairly much impossible. Right? So you have to do a formula to figure out whether any of it's taxable, and the likelihood is even if you take a good-sized distribution, none of it is taxable, or only a very, very tiny fraction is taxable. So we're going to show you an example. To calculate if any of your withdrawal is taxable, follow these steps. Multiply the total distributed earnings shown on the Form 1099-Q by a fraction. The numerator is the adjusted qualified higher education expenses paid during the year, and the denominator is the total amount distributed during the year. Subtract the amount figured in 1 from the total earnings. This is the amount the beneficiary must include in income. Well, of course, earnings are going to be different than the distribution. A percentage of the distribution will be earnings, and it's only the earnings that are taxable, and only then to the extent that they're not spent on qualifying expenses. So here's an example. In 1998, Sarah's parents opened a savings account for her with a QTSP maintained by their state government. Over the years, they contributed $18,000 to the account. The total balance in the account was $27,000 on the date the distribution is made. In the fall of 2010, Sarah enrolled in college and had $6,500 of qualified higher education expenses for the rest of the year. She paid her college expenses from the following sources: a partial tuition scholarship of $3,000 and a distribution from her QTSP of $3,600. Before Sarah can determine the taxable part of her QTSP, she must reduce her total qualified higher education expenses. She takes the total of the qualified higher education expenses, which were $6,500, and she subtracts out the scholarship, $3,000. That leaves her the adjusted qualifying higher education expenses, which can be used to offset the distribution. Well, the distribution is $3,600, and the remaining allowed basis in those expenses is $3,500. So we essentially have $100 of distribution that is potentially exposed to tax. And now we need to apply the formula. Sarah's Form 1099-Q shows that $1,200 of the QTSP distribution is earnings. She takes $3,600 out, and of the $3,600 she takes out $1,200 as income. So it's about 30% income. So she figures it as follows. She takes that $1,200 of distributed earnings, multiplies that by the $3,500 of expenses that are divided into the $3,600 of distribution. And that gives her $1,166 of earnings that are tax-free. But she's not done. She's going to subtract that number from the total distribution to finally arrive at a teeny tiny number, $34, that is actually taxable. And where would that go? Yes, it's other income on Form 1040. Coordination with American Opportunity and Lifetime Learning Credits. An education credit can be claimed in the same year the beneficiary takes a tax-free distribution from a QTSP as long as the same expenses are not used for more than one benefit. Railroad Retirement Board benefits, code 330. Oregon does not tax any of the following railroad retirement income or railroad benefits. Tier 2 retirement income reported on Form RRB 1099-R. Tier 2 unemployment or Tier 2 sick leave. We already know that Oregon does not tax Social Security, and it does not tax the railroad equivalent of Social Security, but that subtraction is taken earlier on the Social Security line. This is a separate subtraction claimed on the other subtraction line, and it has to do with Tier 2 benefits. Tier 2 benefits are typically seen as the pension equivalent or the pension portion of railroad retirement. But it happens to be the case that any type of income pretty much from the railroad other than wages is not taxed by Oregon. So unemployment and sick leave both are also not taxed by Oregon and appear as subtractions on the Oregon return. But please note the benefits received must be from the Railroad Retirement Board to qualify. No subtraction is allowed for benefits paid by private railroad employers. Scholarship awards used for housing expenses. Oregon does not tax scholarship awards you received and used for housing expenses. If you included taxable scholarships as income on your federal return, you can claim an Oregon subtraction to the extent the income taxed on your federal return was used for housing. Caution, no deduction is allowed for mortgage interest or real estate taxes deducted on the federal return. Well, what can I say about this? Most of the time that I've encountered taxable scholarships has really been historically because the client I had was extremely honest and just came forward and said, oh yeah, I've been working down at OHSU and I've been receiving $2,000 a month as a stipend, and it's essentially a taxable scholarship, but it's not being reported anywhere. Do I have to report it? And of course the answer is, well, are you spending any of the money on tuition? And the answer will come back, no, I am doing mainly research there, so I'm getting, education credit for the time I'm putting in, but I'm not paying for the time. And on top of that, I'm being paid for my time. And so that is essentially taxable as wage income, and it should appear on line 7 with a code SCH written on the line next to line 7 to recognize that income. And one of the big sources in our community here in Portland is OHSU. I can remember going back to tax seasons as early as, say, 1995, 1994, having, in particular, foreign students from China come to me, kind of because at that point we had booths in the Fred Meyer stores, and they'd be shopping there, and they'd just stop by the booth and kind of volunteer up that they had this income that they were getting. But when we finally sat them all down and did all of the research and talked to IRS experts and told them it was taxable, they disappeared. So anyway, an interesting thing has happened. All of a sudden, OHSU is issuing 1099 miscellaneouses to these scholarship recipients. And it's not just OHSU. I'm seeing these scholarships coming out of other institutions around the country. So what I am guessing has happened is after a very, very long run, lasting many, many years, of not having any reporting requirement to the IRS, these colleges have all of a sudden been going through some audits and apparently getting in some amount of trouble. And so now they're knee-jerk reacting by issuing 1099 miscellaneouses. And I don't know necessarily that that's the correct form to report it on, but they're doing it. So because more people are doing it, or more of the institutions are doing it here in Oregon, there's probably going to be more opportunity to have clients coming in who have taxable scholarships that have been reported to the IRS, and that means you have an opportunity on the Oregon return to be going after this particular subtraction. So if you have a client who has a taxable scholarship on the federal return, they are allowed to claim a subtraction on Oregon for the cost of their housing expenses. So what exactly is included in housing? Well, it's actually room and board is one of the descriptions that they're giving. And so it can include more than just rent. It can also include utilities and so forth. But do not claim a subtraction for any expense that you've already deducted on Schedule A for mortgage interest and real estate taxes. Be careful of that one. Mobile home park capital gain exclusion. If you sold your mobile home to a not-for-profit tenants association and you reported the gain on your federal return, you can claim a subtraction on your Oregon return. The subtraction applies to sales made January 1, 2006 through December 31, 2013. Federal business credits. If you reduced your business expenses or itemized deductions on your federal return because you claimed a federal credit, you can claim an Oregon subtraction for the amount of expense not deducted on the federal return because you took the credit. So here we're back on this theme again. If your federal credit is from a partnership or S corporation, you may claim an Oregon subtraction based on the percentage of ownership in the partnership or S corporation. For example, Jake is 50% owner in the partnership Under the Sea LLC. In 2010, Under the Sea installed disabled access improvements costing $4,000 and claimed a federal credit of $2,000. Under the Sea reduced its depreciable basis in the access improvements by the amount of the federal credit and claimed a Section 179 deduction for the remaining $2,000 of cost. Since Jake is a 50% owner of Under the Sea, his share of the federal credit is $1,000, and he will claim an Oregon subtraction of $1,000 for his 50% share of the federal credit that could not be deducted under Section 179 because the disabled access credit was claimed instead. So we're going to pick up with a discussion of taxable benefits for former RDPs, code 347. This is actually a subtraction that I've never quite understood. In the days before Oregon had registered domestic partnerships, you were allowed to claim a subtraction on your Oregon return for all of the taxable health insurance benefits that were included in your income that were for your same-sex partner. And then with the introduction of registered domestic partnerships, that subtraction went away. I don't understand why it went away, but it did. But it's bad. It's still around, but only if you end your domestic partnership during the year. It's weird. Maybe someone can enlighten me, but I've never been able to quite understand why this is. If you and your registered domestic partner dissolved your partnership during the year, you may be allowed an Oregon subtraction for the imputed value of certain fringe benefits provided by your employer for your RDP for the part of the year that you were still registered domestic partners. These benefits typically include, but are not limited to, health insurance and tuition payments. You must have included the imputed value of the benefits in your federal income to claim the Oregon subtraction. The imputed value will continue to be included in the total compensation of box 1 shown on your W-2. Difference in 1/2 of the self-employment tax deduction. Well, this is a weird one that's in place for 2010 only, and again it has to do with that same concept. If I gave up a federal deduction, Oregon's going to allow me to have it if Oregon would have allowed me to have it when I hadn't given it up on the federal. But this one has nothing to do with federal credit. It actually has to do with a federal deduction being claimed that reduces the tax on the federal, and that tax is deductible on Oregon, or something like that. So let's see what I mean. It's called the difference in 1/2 of self-employment tax deduction. For 2010, you can claim a federal deduction for the cost of qualifying health insurance premiums as a deduction against your federal self-employment tax. Since the net self-employment tax under this new rule is less than it was under 2009 law, the federal adjustment for 1/2 of self-employment tax claimed on line 27 of Form 1040 is less than it otherwise would be. If the federal deduction for 1/2 of self-employment tax is reduced because a taxpayer reduced his or her self-employment tax by deducting the cost of health insurance premiums, Oregon will allow the difference between the amount of deduction allowed on the federal return with health insurance and without health insurance to be claimed as a subtraction on Oregon. What? Okay, let's see what we mean by that. Here is an illustration. Thank goodness I did that for you, right? Sam McGee has net income from self-employment of $100,000. He paid $10,000 for health insurance premiums for himself and his family. He is not eligible to participate in another employer plan. Line 6 of Sam's Schedule SE shows his deduction for 1/2 of his self-employment tax is $6,359. Had Sam not reduced his self-employment tax by claiming his health insurance premiums as a deduction, his self-employment tax would have been $1,530 higher, and his deduction for half his self-employment tax would have been $765 higher. So what will the Oregon subtraction be? $765. Sam will claim an Oregon subtraction of $765 for the difference in 1/2 of the self-employment tax. Use code 346 and enter the subtraction on Oregon Form 40, line 18. So I threw up the Schedule SE here for you. We're showing the net profit from the business but we're also reducing the amount of that profit subject to self-employment tax by the $10,000 that was paid on self-employed health insurance premiums. We then use the $90,000, we multiply that by 92.35% to get the amount of income on which we are going to calculate self-employment tax, $83,115, and that gives us this particular amount of tax. Had we assessed self-employment tax on the $100,000 instead, then we would have had self-employment tax that was $1,530 higher, and the difference being $765. That is a difference in the deduction for 1/2 of the self-employment tax. Here's a new deduction that started in 2010. A very distinct group of people who get laid off, but they're really well laid off people. Beginning in 2010, Oregon will allow a subtraction for severance pay that is invested in a qualified Oregon small business. Severance pay that you receive during the tax year and invest into a new or existing small business is eligible for the subtraction. To qualify, you must materially participate in the operation of the business. The business must be formed as a legal entity with the purpose of making a profit. It must be independently owned from all other businesses and have 50 or fewer employees. Your investment in the business must continue for at least 24 consecutive calendar months following your termination from employment. The subtraction is limited to the lesser of your minimum investment, or $500,000. You must claim the subtraction in the year the severance pay is received. If the pay is received late in the year, the individual has until the due date of the return, including extensions, to make the investment. For more information and examples of when the severance pay subtraction is and is not allowed, follow this URL. Well, we're finished with Oregon subtractions. We're now going to take a look at Oregon deductions. So I just want to kind of reorient you with the Form 40 and where I am next. So here's our Oregon Form 40. And we started off the day talking about Oregon additions. And then we moved on and spent a good deal of time talking about Oregon subtractions. And now we're into this section right here, the deductions section. And the deductions section either has to do typically with the standard deduction or Oregon itemized deductions. So we're going to talk about the rules relating to filling out this particular portion of Oregon Form 40 next. Oregon deductions. You can itemize or you can claim a standard deduction on your Oregon return. If you claim itemized deductions, Oregon says complete lines 21 through 25 of Oregon Form 40, and if you claim the standard deduction, fill in line 26 instead. Note that the Oregon rules are the same as the federal rules for married filers. If you are married or RDP filing separately and one spouse or RDP itemizes, then both of you must itemize deductions. If your spouse or RDP itemizes and you do not, your standard deduction is 0. Form 40, line 21, itemized deductions. Oregon allows most deductions allowed on your federal Schedule A. In addition, because your Oregon standard deduction amount is usually less than your federal standard deduction amount, you may find it beneficial to itemize on your Oregon return, even if you did not itemize on your federal return. You can do what's called itemizing deductions for Oregon only. And to itemize for Oregon only, complete federal Schedule A as you would if you were itemizing on the federal return. Be sure to include your state taxes even when itemizing for Oregon only. Use your federal adjusted gross income to figure the Schedule A limitations. If you itemize for Oregon only, keep a copy of Schedule A for your records, but do not include it with your Oregon return. Line 22 on Form 40 has to do with the special Oregon medical deduction. If you or your spouse or RDP was age 62 or older on the last day of the year, you can deduct all of your allowable medical expenses on your Oregon return without regard to the 7.5% limit imposed on your federal return. To claim the special Oregon medical deduction, refer to Schedule A line 1 or line 3. Whichever amount is less is the number you enter on line 22 of Form 40. To claim this deduction, you must itemize your deductions for Oregon. So I've done an illustration for you of how this works. Janice is a single filer, age 63, with adjusted gross income of $40,000. She claimed the standard deduction on her federal return, and she has the following deductions to itemize on her Oregon-only Schedule A. Medical expenses of $5,000, Oregon income taxes of $2,000, and property taxes of $1,000. Even though Oregon does not allow her a benefit for taxes paid to Oregon on Schedule A, Oregon still wants her to include those taxes on Schedule A when she figures her Oregon itemized deductions. And the Oregon itemized deductions actually are whatever amount you compute on Schedule A. And in this case, I've only given entries on the first two lines for this particular Schedule A, line 4 and line 9. There are no other deductions that fill out on the Schedule A. And those two lines total $5,000. So that $5,000 carries to line 21. And now we're dealing with the Oregon Special Medical Deduction. The Special Medical Deduction is the lesser of the number on line 1 or line 3. The number on line 1 would be the lesser number if the deductions are less than 7.5% of the income. If you have a number on line 3 and a number on line 3 in this case is the lesser number, and it's going to be the one that you get to claim, because 5 minus 3 is 4, and that 2 is already being claimed. So the 3 is an increase to Oregon itemized deductions, and that takes Oregon itemized deductions up from 5 to 8. The next step is to subtract out Oregon income tax claimed as an itemized deduction, and in that case it's $2,000, as we see on line 5. And that gives us net Oregon itemized deductions of $6,000. That carries to line 27. And we're done with that exercise. Of course, there is a line 26, and line 26 is where you enter your Oregon standard deduction. We'll talk about that in just a moment. In the meantime, back to this line 24 item, state tax claimed as an itemized deduction. Oregon does not allow you to claim a deduction for income taxes paid to the state of Oregon or taxes paid to another state if you are claiming a credit for tax paid to the other state on your Oregon return. Well, the credit for tax paid to another state, we're going to get into that this afternoon, but I wanted to give you in your mind an example of when you would claim a credit for tax paid to another state. You claim a credit for tax paid to another state when Oregon and the other state are taxing the same income. In order for that to happen, you typically either have to be a full year resident of Oregon with income from another state, so that the other state and Oregon are both taxing that income, or you have to be a full year non-resident of Oregon who is a resident of another state who has income from Oregon that both Oregon and the other state are taxing. That is the type of situation where you will have eligibility for a credit for tax paid to another state. The more common situation that we have where people pay tax to two states is when you're dealing with a part-year resident, someone who, say, lived in Idaho, worked in Idaho part of the year, and then moved to Oregon. So they would have lived and worked in Idaho and paid Idaho tax for part of the year, and then moved to Oregon and lived in Oregon and paid tax to Oregon for the other part of the year. And in that situation, Oregon taxes the Oregon income but does not tax Idaho, and Idaho would not tax Oregon income after the person is no longer a resident of Idaho. So part-year residents, it's far less likely you will ever deal with a credit situation. So in order to be dealing or expecting to be calculating a credit for tax paid to another state, you're usually, although there is an exception to this, going to be dealing with a person who is a full year resident of one state and a non-resident of another state. And it's very rare that you would ever have a situation where part-year resident in one state and part-year resident in another state is going to trigger a credit somehow. But I will give you an example where that would generate a credit, because I dealt with it this year. I had a client who was a resident of New York. And while the client was a resident of New York, he worked in Massachusetts. So was working at a temporary job site in Massachusetts as a resident of New York. So New York and Massachusetts are taxing the same income. And then that person moved to Oregon. So the tax software was going batty on me. I could tell it was going batty because Oregon was trying to give a credit for tax paid to Massachusetts and or New York, which wasn't allowed because they weren't a resident of Oregon while they were earning the money in New York and in Massachusetts. And on the other side, New York was trying to give credit for taxes paid to Oregon, but the Oregon taxes paid after residency in New York ended. But there was a situation there where the New York return could claim a credit for taxes paid to Massachusetts. So that can happen. So let's just clock over to this side of the continent and say, okay, I'm in Oregon, and while I'm in Oregon, I have a job in, say, Utah temporarily. So I'm paying Oregon tax and Utah tax on the same income. And then after a period of time, I actually physically move to Utah and decide I'm going to stay there. You could have a situation where you're a resident of Oregon, working in Utah and paying taxes to both states, and then after a period of time, you actually switch residency to Utah, and on the day that residency changes, you no longer have tax to Oregon. So it is technically possible to have tax paid to another state credit on a part-year return, but as you can see, that type of situation would be rare. Far less common than a person just pulling up and moving, right off the bat. So what does Oregon have to say about state taxes claimed as an itemized deduction? Oregon says you can claim a deduction on Schedule A for taxes paid to any state except Oregon. So if you claim taxes to Utah or California or anywhere else, those are deductible on Schedule A, and Oregon will not add those back into Oregon income on line 24, except where you also claimed a credit for tax paid to that state, and that's where my caution is. Make sure you're not thinking there's a credit availability when there is not. Okay. Now, Oregon income taxes. If you claimed a deduction on Federal Schedule A, line 5A, for income taxes paid to Oregon, you will enter that amount on line 24. Local and county taxes. Local and county taxes are allowed as a deduction on your Oregon return. Do not include on line 24 amounts paid for local or county income taxes that you paid. And for the brief period of time that we in the city of Portland, the Tri-County area, actually had a Multnomah County, actually it was a Multnomah County tax for 3 years, that was completely deductible on Oregon, and it was not added back into Oregon income on line 24. That included or forced a bunch more overrides on the software programs back in those days. Income taxes paid to other states. Oregon allows you to deduct taxes paid to other states. However, you cannot claim a credit for taxes paid to another state and then also claim an Oregon itemized deduction for those same taxes paid. If you are claiming an Oregon credit for income taxes paid to another state and deducting the other state's taxes on Schedule A, include on Form 40, line 24, that other state's 2010 net tax liability or the other state's 2010 tax claimed as an itemized deduction, whichever is less. And here again is Oregon standard deduction. We started off our class actually showing you Oregon standard deduction because the standard deduction is the filing requirement for part year and non-residents. But the Oregon standard deductions are shown here. You will add $1,000 if you are age 65 or older or blind and you are married. And you will add $1,200 if you are age 65 or older and any other filing status. Okay, so I just remembered there's a classwork assignment I wanted you to work on, and it has to do with Oregon additions and subtractions. So the classwork assignment is near the end of your manual, I'm guessing. Thank you, 85, I appreciate that. It involves a character named Jason Judson. We're showing you as a federal adjusted gross income, and it's divided up into these types of income. Wages of $55,350, Oregon tax refund, and the Oregon lottery. Also during the year, Jason contributed $2,000 to his nephew's Oregon College Savings Plan, and he received a refund of $1,005 on his 2007 amended return. The tax liability on his original federal filing was $5,007, and the tax liability on his amended filing is $402. Jason's 2010 federal tax liability is $5,163. His federal Schedule A is attached. He will receive a $400 making work pay credit. Have fun preparing his Oregon return. Okay, and there's the Schedule A. Menu, there it is. And I'm going to start with a review of this classwork answer key. Oh, and I guess this means I need to give you a password too. So online students, the password to give you to unlock the classwork answer key is Ashland. All right, so just taking a look at the tax return for Jason Judson. He has a few things going on with his return. The first one is that he has an addition code for his federal tax refund. So you need to enter $1,005 of that refund as an addition on line 10Y. The next part is that you had to figure out his federal tax liability subtraction. And that meant taking the federal tax from the federal return and then subtracting out the making work pay credit. The next part was to enter a subtraction for the Oregon refund that was included in federal income. And then it got a little more complicated because we had to complete Oregon Schedule ASC. So we did that schedule because there are more than one other subtraction, and the two subtractions were for the Oregon Lottery and also for the Oregon College Savings Plan. So the winning ticket that is not taxed by Oregon, because it is less, is $600 or less, is $550. So that is a subtraction we need to enter on the schedule. And the second subtraction, of course, is the Oregon College Savings Plan. So let's go down and take a look at these finished forms. And you can see that my computer software also has generated this computerized version. And it's pretty much not possible to get our software to give us this non-computerized version. And it's just a matter of adjusting to how it looks. The content on the form is all the same. It's got all the check boxes. They just appear in a different place. And then it also has a checkbox for a new address, the checkbox for extension filed, checkbox for donate kicker. They're all there. And then, of course, we check a box for himself for his exemption, plus no other exemptions. He just gave money to his non-dependent nephew, right? Put it in the college savings plan. We have interest and dividends on state and local bonds outside of Oregon. That box is blank. We didn't have any of that type of income, but we do have another addition for that federal tax refund of $1,005. We also have the federal tax liability, and you had to remember to subtract out the making work pay credit. We then on line 15 entered the Oregon tax refund that was included in federal income. And then we went down to line 18, and this time we check box 18Z. We enter the total of the two subtractions, but we have to go and do Schedule ASC. So that's a couple pages down in our answer key, and here it is. So we're leaving all of these other boxes blank because they do not have more than one other number. It's only under the other subtractions that we have code 322 and code 324. We total those and carry that 2550 to the front page of the Oregon Form 40. And enter it right here, 2550. And then the rest of it should have been fairly elementary. Did any of you actually get to the point where you calculated his tax? And it was $3,166, and he has a refund of 2011. Perfection. Okay, so that was a pretty simple exercise.
And that concludes Welcome to Oregon Part 2 of our Basic Tax course. It's now time to review your homework assignment that you need to complete before you begin Part 3 of Welcome to Oregon. Homework assignment is actually a two-part assignment, and it involves a character named Alex Smith. Alex is single, and he is a construction worker. He worked at a temporary construction site outside of the metropolitan area for 9 months of 2010. His one-way commute was 58 miles, and he drove to the temporary work site 180 times during the year. For the rest of the year, his round-trip commute to work was 8 miles, and his in-town commute miles were 480. He had the following work-related expenses. Alex began driving his car to the temporary job site on 1/1/10. This is the first year he has driven his car for business, and he put a combined total of 27,000 miles on his vehicle during the year. Alex does not own another vehicle. During the year, Alex also paid the following expenses: charity and his Oregon balance due. And also during the year, he amended his 2007 federal return. The amendment reduced his 2007 federal tax liability from $5,600 to $4,950, and he received a federal refund in the amount of $650. Alex also played the Oregon Lottery, and he had the following winning tickets. During the year, he had gambling losses of $3,000. Alex cashed in his Port of Seattle bonds during the year and received $1,400 of interest income from those bonds. Alex will receive a $400 Making Work Pay credit on his 2010 Form 1040. Here is his W-2, and go ahead and prepare his tax return. We can see he has $42,000 of income, $3,000 of federal withholding, and $3,000 of Oregon withholding. For homework assignment number C, we want you to assume all of the same facts regarding the character named Alex, except for homework assignment number C, he is not going to itemize his deductions. He's only going to claim the standard deduction. And so instead of itemizing his deductions to claim his employee business expenses, we want you to look at a reduced amount of expenses and instead claim the subtraction for commute expenses of construction workers. And the password to open the Welcome to Oregon Part 1 homework answer key is Kenya, Kenya. Please complete homework assignments B and C at the end of your student manual. And after you're finished those assignments, you can read up on the Oregon Additions and Subtractions reading assignments. And then when you are all finished with all of that, I'll see you again at Part 3 of Welcome to Oregon. Bye-bye.